500 trying to stage a recovery, just about unchanged on the S&P, down on the week by about 1% so far this week through Thursday. The Nasdaq slightly positive. The Nasdaq 100 yesterday, best day of gains so far this month, in the month of May. Even with this in the bond market, 2-year, 10-year, 30-year shaping up as follows. 2-year around 450. We've had 10 consecutive days before today of yields climbing, yields dropping today by 5 basis points. But still, over those 10 days, with yields up something like 50 basis points, call it 60 basis points higher, the Nasdaq 100 is up 4%, more than 4% over the same period. That rate story, Tom, hasn't taken a bite out of the enthusiasm in the equity market.
Well, the enthusiasm of pretty good GDP numbers, including the second view we saw in first quarter yesterday, John. Further inversion now, and I don't know if 70 basis points of inversion's out by near 100 basis points, but the trends in place and the real yield, John, the 10-year real yield, 1.53%. That is a change from 7 days ago.
Looking at the nominal yield week to date so far, up something like 22 basis points on the front end in the US. In the UK, we've had a 58 basis point move this week.
Yeah,
at the front end
I'm
of the
glad
yield
you
curve.
mentioned this. Germany, too.
CPI, hot. Pressure on them to hike again. So some really interesting moves in the FX market off the back of some of this too. So let's finish on the euro against the dollar. The euro against the dollar right now at about 107.33. Yesterday coming really, really close to a break of 107 after getting close to breaking 111 not so long ago. Yesterday, the low of the session, Tom, 107.07. Not too far away from talking about 106 going into this weekend.
I mentioned a couple days ago, technically a free fall from 107 to 105. We're not there yet, as we haven't breached 107. It's going to be an extraordinary day. I'm nervous. I'm reading auto. We got Ricardo coming up here.
Very cool.
So we got a bigger superstar than Ricardo coming up right now.
Dom Constant. Are you saying Dom Constant's a bigger guy than?
Yeah, he's huge.
Than Danny Rick.
Yeah, Dominic Constant is.
Do you want the good news today?
Yeah.
And it's the long weekend. No Fed speak. No Fed speak whatsoever from Federal Reserve speakers. They take the day off going into the long weekend.
Yeah, but when Dominic Constant talks, it is Fed speak. He's that influential.
Dom Constant's got to say over at Mizuho on all of this, the Fed speak we've heard so far this week. We still expect the Fed to pause officially in June, and the next move will be a cut. The credit crunch is slowly beginning. And as long as the layoff rate continues to rise, there is scope for a sharp rise in unemployment on the back of lower vacancies. That's certainly not what you saw in claims yesterday, but this is the conversations people are still having, Tom.
There was a conversation 90 days ago, out front 100 days ago, and this was Dominic Constant of Mizuho Americas, certainly lean forward global Wall Street. And let's get an update right now. Dr. Constant, it's real simple. There's two Americas out there. There's everybody else flat on their back, and there's people that own NVIDIA. They're all out in the Hamptons celebrating this weekend. What does your super restrictive take on the Fed mean for the Hamptons? I'm fascinated by where we are, your super restrictive Fed, and where we're going to be when the first leaves fall in the Hamptons in October.
Well, yeah, I think this is kind of the calm before the storm, so to speak. Nothing really has changed over the last few months in terms of the underlying trends of a slowly slowing economy. Basically, you are having credit conditions obviously tightening, and lending growth is slowly slowing. And a number of things in the pipeline, such as when the debt ceiling is passed and a lot of T-bill issuance takes place, that will kind of challenge, if you like, the banks again in terms of potentially losing more deposits. And so I think the idea is just a question of patience. The immediate crisis, whereby in some sense the Fed needed to cut rates, let's say, at the June-July sort of meeting. Obviously, that's all backed off now, but it doesn't mean that the underlying problems have suddenly sort of gone away. They're still there. And as you say, the real risk is that the unemployment rate rises much more sharply towards the end of the year, and that will have a whole new meaning for the Fed. Right now, they can fight inflation because there's that's the main issue. There's nothing else seems to be a problem, but it will be a problem if unemployment starts to rise faster than most people expect.
What is the rate of change on that? I mean, do you expect, this has been a debate on the show, Dominic, the basic idea of non-farm payrolls, 220, 230, 250,000, everyone agrees it's coming down. But what do you suggest will be the way it will come down to 40,000, or dare I say a negative non-farm payroll statistic?
Well, the issue really goes back to a debate that the Fed itself had, Governor Waller had with Larry Summers, in terms of you can think about how unemployment rises. It rises either because demand for labor is going away. It can rise also if the supply of labor is going up due to people getting fired or rejoining the labor market. The issue is what happens if both happen at the same time. If people start getting fired and that demand is going away, and the demand is reflected in vacancies. So I think the path, you could see quite a sharp rise in unemployment as those two things collide. And those are the very statistics that Governor Waller himself put out in the paper with Andrew Figueroa in July last year. They had an example where a 50% jump in layoff rates could lead to unemployment essentially doubling from these levels. So I think the path, if you like, for a quick drop in payrolls around, say, end of Q3, Q4, is certainly plausible. And that, as I said, that will the Fed historically starts to cut rates when unemployment only rises on average 22 basis points. That's for the last 5 cycles. They don't need much of a excuse to start cutting rates if unemployment really starts to rise as much as some of those indicators would suggest.
Isn't it the objective now, though, Dom, to see that happen?
Well, yeah, I mean, that's part of the problem. I mean, inflation is sticky. We all know that. I think most of us sort of understand why it's sticky. I think it's to do more with the supply side rather than the demand side. The Fed, it can't be patient really if unemployment is so low. So it kind of needs to see the unemployment rate rise. It's obviously now got the credit tightening on its side for that. And then they can kind of switch gears. But until it does, it doesn't have much incentive to really sort of preempt any kind of loosening up of the labour market while inflation is still sticky. And you mentioned the UK data. I think a lot of people were a bit surprised by that, not just because it was higher than expected, but the goods side was higher. And you saw yesterday Fed officials were talking about concern around goods inflation not perhaps coming down as much as they might have expected in the last couple of months. So those all kind of feed into this sort of nervousness around inflation being still a bit too high. It's got to come down. And if unemployment is still low, then you just keep on fighting it. And it doesn't mean you keep raising rates, but you certainly have a pause and say, I may have to come back and raise rates again if unemployment is still where it is and inflation is still where it is.
You clearly have a different view on where unemployment is going to go from here. Looking for some pretty soft prints on payrolls. You mentioned vacancies. Can we just talk about that conceptually? Don, we saw a lot of reports, a lot of studies done over the last 6 to 9 months. Some people leaning on this idea that you can have vacancies come down without unemployment going too much higher. What's the reality check to that, Don?
Well, I mean, the answer is no one really knows. Empirically, it's definitely true that if you go back through cycles, as vacancies come down, unemployment does rise quite a lot. COVID was so amazing in terms of how the labor market restructured. Companies were getting rid of people in one part of the country and rehiring people in another part of the country. The whole efficiency around the job market basically was temporarily destroyed and has been reshaped. So the truth of it, no one really knows. But there is obviously some good sort of theoretical arguments on the side of the Fed that you could get vacancies coming down quite a lot without necessarily having unemployment go up a lot. And then obviously some people, more people like myself, sort of, we tend to rely perhaps more on historical models and the idea that, if you are going to get a slowdown in vacancies, then the bias would be, the risk is that unemployment just rises a lot more than you think, especially when you have this restrictive policy in place by the Fed. They're not really leaving themselves much wiggle room.
Dominique, you're so cut and chiseled. People don't realize how many years you've been around. Out of Cambridge and Oxford in the 80s, your first day at Credit Suisse, I think it was in the 90s. And it's real simple. I'm looking at the chit chat we have to put up with every day, from, say, Austin Goolsbee of Chicago over to James Bullard of St. Louis. Are these people talking too much?
Yeah. Well, I mean, yeah, they're certainly talking a lot. I mean, the question is whether it's sort of helpful, I guess, for the markets. I mean, in my mind, it's a lot of noise. I think in general, the governors are good people to listen to. You know, I would sort of, you know, I like, you know, the governors. I think the presidents can be, you know, a little bit sort of, you know, just a lot of sort of white noise around the whole conversation. You know, especially if they're not voting, it's, you know, it's much less relevant for markets, obviously.
12 months out, 24 months out, where's the 10-year yield? If we move from a constant super restrictive to something new with a labor deterioration, where's the 10-year end up?
So I think the key thing is really what happens to the supply side, the supply-driven inflation that we're observing is still very high. My guess is a lot of that is still kind of COVID pandemic related, and that will dissipate, especially as you see the labor market normalize. And on that basis, 10-year yields, you know, should come down to 3% or below, because the Fed needs to be getting back to the neutral rate, which Williams now confirms isn't very different from what he thought it was before.
There's that headline a couple of days ago.
Dom, I can't let that go.
Yeah.
What did you make of that?
Yeah, but anyway, the risk is obviously stagflation, and that supply inflation doesn't come down. And we've done some, you know, detailed modeling on that, which suggests the 10-year kind of stays where it is. It's like a 3.5%, 4% kind of yield. It's no big deal, which just means the upside to 10s is probably capped. I mean, you're not, hopefully, you're not going to see a sort of 5%, 6% yield. That you know, talk about the federal, you know, interest cost. You know, you certainly don't want to see that on a sustained basis.
Hey, Dom, I'm not letting you go without answering. What did you make of that Williams piece?
Well, I mean, I'm not surprised. I mean, you know, I think if you massage your data enough, you're going to get the result you kind of want. My intuition is that, you know, he's probably
Can you be clearer,
right.
please?
No, I mean, the low era of interest rates, you know, that we saw before the pandemic, you know, it hasn't suddenly changed because of the pandemic, I think. And statistically, you know, obviously he's able to show that by doing some sort of more fancy kind of econometric kind of analysis. Yeah, I mean, we'll see. I sort of my bias is that the low era of interest rates hasn't changed anyway. I think there's a lot of reasons why people are worried about it changing, but I think you know, no one really knows. I'm happy to run with the flow. And
I think the invitation to
right
Jackson Hole just went out the window for Dr. Constant.
Hey, Dominic, thank you. Dominic Constant there, Mizuho. I do know a man who thinks it has changed. Mohamed Al-Arian thinks it may have changed. Going to catch up with him a little bit later this morning.
I can't, this debate, folks, from Blanchard to Rogoff, they started it. Everybody's on board. Constant and Al-Arian in the camp with Ken Rogoff.
Coming up, absolute rock star of the F1 grid. Coming up next, Red Bull Racing's Daniel Ricciardo ahead of this weekend's Monaco Grand Prix. That conversation up next.
Keeping you up to date with news from around the world with the First Word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for up to 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. And Turkey's central bank has kept its benchmark rate on hold at 8.5% for a third month in a bid to stabilize the lira. The policy decision comes ahead of Sunday's runoff election. President Erdogan is looking to extend his 2-decade rule after leading the first round of voting, but failing to take 50% earlier this month. And the cyclone that devastated large parts of New Zealand's North Island in February has been less inflationary than first feared. The RBNZ initially estimated Cyclone Gabrielle would add 0.3 of a percentage point to inflation in the first and second quarters. The central bank has since downgraded that impact to 0.1, saying while it drove up food costs, it didn't affect other goods. Bloomberg has learned that UBS and the Swiss government haven't agreed to the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules as well. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, You interact with the crew and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
While inflation is still too high, there are some promising signs of moderation, and I believe that we may be at or near the point where monetary policy can pause raising interest rates, and this will provide an opportunity to more fully assess the impact of the actions we've taken to date.
Well, some good news. That was Susan Collins, the Boston Fed president, by the way. Here's the good news. No Fed speak today.
Yes.
Going into the long weekend. We're kind of done, Tom. We don't have to talk about the Federal Reserve and interest rates anymore.
You know where I stand on this.
All finished up, wrapped up, finished, done. Wonderful.
Done. Announcement, Peter Orszag at Lazard. He will take over the reins from Ken Jacobs. This is widely expected. I've known Peter for years. He is a world-class economist out of London School of Economics and brings, John, major policy cred in healthcare toward the Lazard boutique as well. We're going to get to this very quickly because every moment's important in Monaco, and John Farrell's far more abrupt than I am. All I can say is in every sport, there's someone that transcends the day-to-day grind of the sport. You have your heroes. Maybe it's Michael Jordan in basketball. Maybe it's a guy named Judge for the New York Yankees. Daniel Ricciardo is so large for Red Bull and for F1 racing. Anne Hathaway keeled over at the Met Gala when she met him the other day.
I bet she did.
Anne Hathaway fell, I've had good story, fell apart on
We're
meeting
saying
Daniel
here that
Ricciardo.
Hathaway was the fanboy here, not Daniel.
You know, what the problem is, he's wearing Tom Brown at the Met Gala. Thank you, Vogue, for the images. And he puts on a fake bow tie. Can you talk to him, John, when you're in Monaco this weekend? We need Ricciardo in a real bow tie, not a pretend bow tie.
Tied by you. We can talk to him right now. Daniel, I'm pleased to say, joined us going into the race weekend in Monaco. Daniel, wonderful to catch up with you, mate. Just talk to us about how special race weekend is in Monaco.
I thought we were just going to talk about bow ties. Well, all right, let's talk about Monaco. Put it this way, I've been coming here now for 13, 14 years, and it doesn't get old. Like that feeling, I don't know, Monaco is just, it's so special. It transforms into this, honestly, like this magical place. For the race, that rhymes. And you have to, I feel like everyone has to experience a Monaco Grand Prix at least once in their life. It's pretty surreal.
Daniel, just to build on that, one theme for us as we've discussed Formula One, its explosion in the United States with your boss, Mr. Horner, others as well, is whether we risk losing the heritage of the sport as we expand in places like Vegas, Miami, and elsewhere. How do you feel about that?
I think there always, I think, needs to like remain a place for the, as you say, like the historic venues. Your Monaco's, your, I guess if it's Spa in Belgium or Silverstone, Monza. So these places for me should always have a presence on the calendar. But I also love going to new places. And I think, how we're able to open ourselves up to new markets now and see the growth in the States. For me, I love, because I really enjoy spending time in the States. So having like 3 races there is pretty unreal. So I'm somewhere in the middle where I'm definitely open to having new venues, but I think you still have to keep those core few. They shall always remain.
If we can, I'd love to talk about your future as well. You're a super charismatic guy. Your personality, as I'm sure you're aware, has transcended the sport with what's happened on Netflix and beyond. But Daniel, I know deep down you're a racing driver. And I want to understand from your perspective how frustrating it's been, just being on the outside, on the fringes of the sport, being the reserve driver, what it's like being in the simulator, is if it's anywhere near to what it's like actually sitting in the car.
I think this year certainly serves a purpose for me. I did need to kind of, I guess, remove myself a little bit from, literally, I guess, from the driver's seat, just to, in a way, like in simple terms, probably just fall back in love with it again and to really like miss the sport. I'd come off like a more difficult kind of 12, 24 months, like competitive wise. And I was starting just to have too many bad days where I needed a bit of a reset and a refresh. So I'm getting that this year. Sure, it is frustrating to be on the sidelines and to watch, but that's also building like this fire and that desire back. So the plan is to find myself a seat next year, and but I don't want to just be there. I don't want to just get a seat. To say I'm an F1 driver. Right. I certainly want to find my way back to a podium.
Hey, Daniel, you're in the in-between age. I mean, I don't know much about F1 driving, but I've got Alonso making a splash this year at 40-something years old. You got a lot of young Turks following behind you. Tell us the experience value, whether it's Miami or Monaco. What do you sell to a new team or even to Red Bull when you've got a lot more experience? How does that matter in a given race, including this weekend?
Yeah, I think experience is, I think in this sport as well, a lot of sports, but it's very valuable because, it comes in terms of on driving, on track situations. Of course, the more you can read a situation, then that can obviously help, but also then building a car or helping the guys that build the car and design the car, helping them with feedback and understanding. This helps the team ultimately progress and move forward. So that's the value, I guess, in experience. I'm 33 at the moment. As you mentioned, Alonso, he's in his 40s now, and he's having one of the best years of his career. So that's encouraging for me, because there is days you feel a bit old, but then seeing someone like him, you're like, I feel young again. So
yeah,
it's look, at the end of the day, it's how bad you want it. And look, I'm still in shape, and if I want it, then I believe I'll get back to it.
I'm the ugly American learning about Formula One, and John Farrow's been great about explaining to me the Red Bull distinction. I was comparing them to the West Coast Eagles of Australian football, who are in last place right now. You've been Red Bull since you were like 15 years old, 16. What's the Red Bull pixie dust?
Well, I don't know if that was a jab at me, because I love the Eagles, and yes, they're having an absolutely terrible season. But yeah, Red Bull certainly, they're the opposite right now, and they've been, look, for me growing up, they were the program. That was the franchise, if you will, that everyone wanted to be a part of and sign for. They had all the resources to progress you up the ladder if you were having the results. So that for me is like the family that gave me the opportunity, and now being back in the family, it's like, it feels like it's the biggest family I've ever had in racing, and the place where I feel I belong. So right now, like that's my dream, is to be back here with this team racing and hopefully winning another Monaco one day.
You think there's potential to get a seat again at Red Bull Racing, Daniel, or are you looking elsewhere?
I think, look, in this sport, I know things can change so quickly, and even at the end of 2018, you know, when I moved on to Renault, people probably never ever thought they'd see me wearing a Red Bull polo shirt again. So things certainly change and can happen. So never say never. I'm also just like, look, if I focus on myself and apply myself and keep training, keep working hard, then anything could happen. So yeah, and it helps when you got, you know, good looks in this sport. So
of course,
that's what they say.
Like Charles Leclerc. I was just wondering. I know you speak a bit of Italian. You've got that Italian blood running through your veins. Can you imagine being in the red outfit over a Ferrari?
Again, never say never. I feel like it probably would have happened by now, if it would have. So yeah, that one's probably more slim, but honestly, I'd love to be here. That's where I'm at.
That's a nice place to leave it. Daniel, this was a pleasure, a privilege. If you make it to New York, drop by. We'd love to catch up with you. Daniel Ricciardo there.
Yeah, bring Anne Hathaway.
Racing. Of course, bring Anne too. And TK's going to teach you how to do it the bow tie.
Yeah.
TK, what a legend, what a great guy.
What I would say here, and folks, I'm a complete amateur at this. John's teaching me this stuff as fast as he can. Last race, when Verstappen, a colleague of Mr. Ricciardo's, went by those two cars on like the straightaway, you could just see their cars different. He went by
so
two
much
people,
faster.
Like it was just flew by him.
Looking forward to the race this weekend. The race itself can be a bit of a procession, but qualifying could be pretty interesting.
Well, qualies today start, I believe, like 12 noon or 1:30 our time.
Going into tomorrow.
I mean, start like pretty soon. Excuse me. They start at 1:30 Monaco time. So you and I can be watching the qualies in the 8 o'clock hour.
Practice.
They say
qualifying.
that right? Qualies. That's
practice then quali.
Oh, practice and then quali.
Practice
Screw
first.
that up.
Anyway, from New York, this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Look at tech, it continues to reinvent itself over and over.
People are jumping on the stories that look sustainable.
The big picture here, I think, in terms of the economy, is it continues to expand.
There's no way, in our opinion, that the Fed is going to be easing financial conditions anytime soon.
I think they probably try to hold all year, but then next year start to cut.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Itching to get to the long weekend, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Your equity market just about positive on the S&P 500, up by 0.2% after a day of really decent gains off the back of a monster gain on one stock, specifically, Tom. The AI revolution, the frenzy, it's here.
Yeah, we saw it yesterday. We reviewed it in the last hour. We can go through it lightly right now. And the concentration with this NVIDIA success that you see, if you take, I think it's the top 6 stocks, NASDAQ 100. I'm framing out, John, 28% of the NASDAQ 100. That's outrageous, 32%. That's just out of control. How about 51%?
It's
nuts. Made up of those stocks, and NVIDIA on number 3, out to Facebook, down
Go through the numbers. We're up 27% year to date on the NASDAQ 100 right now. And look at the last 10 days before today. Over those 10 sessions, 2-year yields have climbed about 60 basis points. So 10 consecutive days of yields higher. Over the same period, the NASDAQ's up something like more than 4% on the NASDAQ 100. That relationship between bonds and equities that people talk about all the time, that move in yields has not stopped the enthusiasm around the power of some of those names.
The analysis behind that enthusiasm is what is our comfort factor, or how far out we want to go, our terminal value of the profitability of those companies. We were talking retail this week. They make 3 cents on the dollar. They make 6 cents on the dollar. Whoa, they make 12 cents on the dollar. These people are clocking 30 cents on the dollar. Same equivalency, even higher.
And with some stellar growth as well. Potentially
and the
coming much sooner.
Much
sooner than people anticipated.
That's why you see 30 multiples or 50 multiples as well.
Let's get to the price action right now in the equity market on the S&P 500. Equity futures shaping up as follows, just about positive by 0.2%. We take back some of the move we've seen in the yield curve. On the 10-year, we're down about 3 basis points. I can tell you on the 2-year, we're down about 4. Your 10-year, 378. We'll keep returning to what's been developing in the foreign exchange market. That leg of the stool, 3-leg stool, US, Europe, China. The China leg of the growth stool, Tom, just challenged over the last couple of weeks based on the information that's been incoming. I'd throw Europe into the mix as well. And it's developed into this story where dollar has started to regain some strength, and euro dollar's come back from that 111 type level that we were looking at the end of April, back down towards 107.
Pro tip, we're going to be out at Dan Greenhouse's partying on Saturday evening.
Are we invited?
Yes, I think so.
Okay,
if
very
you're
cool.
in China, and you're going the Hamptons, they're all partying like crazy. That's when you act. Are we going to see China? Are we going to see China act this Sunday? Because we're all asleep waiting for Happy Tuesday.
Dan won't be asleep. He joins us now. Dan Greenhouse, Chief Strategist at Solus Alternative Asset Management. Dan, good morning to you.
Good morning to you, sir.
This move in tech, phenomenal. Even with this move in yields, what did you make of that?
Yeah, listen, I think there's clearly a development here in AI, and I don't have anything particularly insightful to say that hasn't been said already. This is another evolution, or appears to be another evolution of the tech space. You had obviously the advent of the internet, the shift to desktop, the shift to cloud, and obviously now this is the next iteration in the development. And I think there is a fair level of enthusiasm that's warranted. Obviously, trading at 30, 40, 50 times sales is always a question, but the argument among growth investors always is that the E or the S, the denominator, is going to be wrong, and ultimately you're going to be proven right over time.
To me, the study this weekend, seriously, we're making jokes about China, maybe they'll do something Sunday or not, is the new thing to study is, what does hold mean? If I own these things, I mean, should I buy them? Should I sell them? The character of a hold right now is really opaque. I mean, I don't know what hold means for Apple, hold means for luxury goods, hold means for NVIDIA.
Yeah, listen, I think, again, if you're, we're particularly deep value credit and equity investors. So what we're talking about isn't in particular our wheelhouse, but in a general sense, in the thematic standpoint, for a lot of these names that are developing generational technologies, whether it's NVIDIA or Microsoft with ChatGPT, et cetera, the idea of holding is simply you're going to go up 30%, you're going to go down 50%, you're going to go up 100%. There's going to be volatility, but you're supposed to ride it out because presumably on the other end of it, you're going to realize the gains, a la Amazon in 2000, Apple in 2005, et cetera, et cetera.
These numbers are rough, folks. Don't quote me on these. Greenhouse had them in his note. His note is just chiseled. It's in English. Right now, big cap, large cap up 30%, large energy up 3%. Is energy deep value?
Yeah, I mean, we think so. You mentioned this before, and before we get off of tech, I just want to point it out.
Oh, I'm sorry. I went to energy. I didn't know the script here. Please tell us about tech right now.
You mentioned before about John was talking about how the stock market's up while Treasury yields are up, and obviously there's plenty to talk about in the Treasury market. Sure. But to be clear, these names, the tech names that we're discussing, are driving the gains. And I looked yesterday. The median stock among the FANG or the MAGMA, whatever acronym we want to use, they're up about 35% year to date. The median stock in the remaining 495 is down 2% year to date. There is a tremendous bifurcation in size across cap, whether it's large, mid, or small cap. Larger names are doing better, but particularly in large cap, you have just tremendous outperformance with Tesla and NVIDIA and Meta and the like, and then everybody else is not quite doing as much. And so I think looking at the headline index in general belies some beneath the headline developments, even more so right now. But to ramble further on to energy.
Please do.
I think energy presents a lot of value. You've had tremendous developments in the space over the last couple of years that have resulted in even more attractive investment opportunities for several funds willing to step into the space. And what are those? And we know many of them. ESG has scared a lot of investors out of the space. The implosion in energy prices over the last couple of years has resulted in a lot of energy-focused managers stepping away, and that's created some value opportunities for the likes of us. And then at the same time, and you see it right now, the names aren't just derivative plays on oil themselves. Oil itself is off, call it 40% from the high. Broad energy stocks are only down about half of that. Some are down even less because they're much more now a capital return and an investment story than it is purely an exploration and production story. And that presents a terrific opportunity for funds such as ours and others to try to exploit some of these dislocations in the market.
Let's unpack some of that then. So the S&P 495, I've heard a lot of people joke about that over the last couple of weeks, and I'm with you. Maybe we should build that, Tom, as an index here at Bloomberg, the S&P 495, and strip out some of those big tech players.
It could be like the Dow Jones Industrial Average.
Yeah. Are we going to market cap weight that?
Yeah.
Yeah. Price weight it. Let's give that a miss. Dan, there are odd things happening, though, in this equity market. We were mentioning offline, and I think it's worth having this conversation online. The home builders since last June are up 70%.
Sure.
Let's just walk through these odd dynamics right now. Elsewhere, you've kind of got like manufacturing and recession, services booming in certain places. We have these broad, generalized conversations about the economy. The economy's doing X, but beneath the surface, you've got like 20 different economies doing radically different things.
Yeah, I think that's right. And admittedly, that's largely true quite often. The best example that comes to mind when you mention that is the 2014-2015 period, when the industrial part of the economy was largely in recession, and we were worried about a broader economic recession that never materialized. But it also speaks to the diversification in a $20 trillion economy that it's really hard to drag the entire thing down into a recession. But to your point about the builders, and I think this is largely the result of the activity post-GFC, which is everybody underbuilt. We knew that as it was happening, and you were set up for a moment in time where if there should be a surge in demand for your product, aka houses, you just wouldn't have the inventory there to meet it. And COVID came along and just absolutely blew the supply-demand metrics as we understood them out of the water. And what you have now is a situation where 95% of homeowners are locked into, call it sub-3% mortgages. So they're not selling and taking on a new 6.5–7% mortgage unless they have to. And so you're forced to buy a new home, which is more expensive, but also the result of the builders. And so the builders are excited about this, and ultimately it's driving a lot of the developments that we see in the space.
This gets to the heart of the bigger economic debate at the moment, and that's the recession call. Do you think we face that kind of scenario? Back in 2014, it was very much China-led. Going into 2016, it's basically services going to come down to manufacturing. Do we face a different scenario this time, or is it the same again?
No, listen, I think every recession is a new spin on the roulette wheel. And this actually is a good opportune moment for me to push back on something that people talk about all the time, which I despise.
Please do.
Which is the idea that we've been waiting for this recession for 2 years.
Would you want?
This is nonsense. What happened was, when the Fed started raising rates, people were saying, we're going to have a recession probably next year, meaning 2023. At least my view was we're probably going to have a recession in the middle of 2023. That doesn't mean I expected a recession between now, early 22, and 23. It just means when the Fed raises rates, they usually break something and you have a recession. The truth is, the recession was supposed to happen around now. It appears that it's not going to be the case. And so now you have your first real instance where you're pushing out your recession call from, call it Q2, Q3 to Q4, Q1.
You're hugely identified with my good friend Carl Keatoney and other Scott Wapner over at the Death Star, which is talking about moving things, moving out, doing trades and that. Are people trading too much to create legit alpha?
Probably, but I mean, listen, we know the holding period for equities has been in decline for decades now.
It's Cramer's fault, but other than that,
I don't think we can blame purely Jim Cramer for it. We all bear some responsibility for that development. But listen, I think the research is crystal clear that long-term holdings of value stocks tend to outperform. And obviously there are periods of time that's not the case. And if you look at NVIDIA yesterday.
Where are we right now? Where are we into the end of this year? Is it going to be a trading? Do you need to be supple here? Or do you load the boat on an energy stock that's out of
Listen, I think, a lot of people don't have our holding period. We have some names in the portfolio that the PM has held for 10 years, for 12 years. A lot of people don't have that. I've owned Home Depot since 2009. I don't think a lot of people do that anymore. But I think, listen, what you're dealing with now is a quote-unquote expensive market when viewed from the headline. Although another thing I'd like to push back on is the second derivative of that argument is you have a huge expansion in tech stocks, which is going to drag up the whole market's PE. And so it's not as simple as just saying the market is expensive, but you have on its headline an expensive stock market up against the Federal Reserve that is not cutting rates anytime soon and is trying to engineer an economic slowdown. And if the last 60 years of data shows anything, it's that the Fed, generally speaking, gets what it wants.
We should do a segment next time with you, just Dan Greenhouse's pushbacks. Like 3, 4, 5.
Things with which I have a problem.
Pushback.
Home Depot.
Love that.
Home Depot from 2009 up 23% per year.
It's not bad, is it?
Can we sponsor that segment by anger management?
We should do.
Okay.
We should do. Hey, Dan, this was great. It's good to see you.
Thank you,
Enjoy
guys.
the weekend. Thank you. Dan Greenhouse there of Solus, Alternative Asset Management from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. Republican and White House negotiators are said to be moving closer to an agreement to raise the U.S. debt ceiling. Sources say the emerging agreement would cap federal spending for 2 years. If a deal is reached soon, a vote in the House of Representatives is likely to take place on Tuesday. Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's weighing on profits. Jacobs will become Lazard's executive chairman. And shares of Marvell Technology are surging in pre-market trading after the chipmaker said it expects sales of AI-related products will at least double this year. Adjusted earnings for the first quarter also beat estimates. It's the latest chipmaker with a rosy forecast on AI. NVIDIA's market value jumped past $930 billion on Thursday. And wealth bankers in Asia at UBS and Credit Suisse will get a rare incentive for bringing in new money. They'll get a cut of the cash, equal to 15 cents for each $100 of new client money. That's according to people familiar with the matter. Asia was once a key battleground for the Swiss rivals, but they're now trying to show clients stability after that emergency merger back in March. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Deadline closes
Back
in.
and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling. They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
The reason why we're here, we've got more money in any given time coming into our government. But when the Democrats took the majority, they are now spending more than any time in our history, and our debt is higher than any time in our history. So let's just get this right.
It's my understanding that the designees of both President Biden as well as Speaker McCarthy will continue to talk, but it is unfortunate that House Republicans have chosen to get out of town before sundown when we are facing a dangerous default.
House Speaker Kevin McCarthy, House Minority Leader Hakeem Jeffries. The back and forth, the blame game continues in Washington, D.C. Publicly, privately behind the scenes, the contour of a deal might be coming together. We'll talk about the details of that in just a moment. Welcome to the program. In the equity market, S&P 500 futures are positive by 0.2%. Big gains yesterday on the S&P. Big gains on the NASDAQ off the back of that monster move in NVIDIA. The NASDAQ 100 had its best day of gains so far for the month of May. As we move towards the end of the month of May, yields have been on the climb over the last 10 days, that's for sure. Today, a break. Yields are lower by 3 basis points to 378. At the front end where the bulk of the move has been, we're down 3 or 4 basis points on a 2-year to about 450. Worth reflecting on this, though. I feel like we haven't talked about it much. The 2-year versus the 10-year. That curve, Tom, back to negative 70. Something, negative 70 right now.
Let's go up Priya Misran. You're going to do this right now with someone who made a great call here. This is a vanilla spread, the difference between the 2-year and the 10-year yield. And John, any kind of inversion's a big deal. Oh, it signals a recession and all that. And Priya came out and said, hey, we're going to 60 basis points, 0.60% between the 2-year and the 10-year. We said, you're nuts, Priya. Then she recalibrated to 80 or 100 basis points with Ira Jersey. We got there. We pulled back. And this week, we're coming back down again, a greater inversion.
Well, forgive the bond market jargon, but ultimately what happened, what started to develop was that classic bull steepener, which effectively means the front end of the yield curve starts to drop, the 2-year starts to rally, anticipating a rate-cutting cycle. And what we've done over the last couple of weeks is take some of that back, take a lot of it back. We've priced out rate cuts and started to price in rate hikes off the back of Fed speak, which has encouraged that stance. There's been a persistent effort, I think, from Federal Reserve speakers, regardless of whether they think hike or pause, but ultimately no cuts, 1. And 2, it's been validated and supported by the incoming information. Whether you look at the economic data, where you look at the economic data, look to claims yesterday. Claims yesterday adjusted off the back of that Massachusetts story and the fraud, and we've got to take some of that out. And we're coming down. We're not going up. That's been a change.
I agree. And Dominic Constam on earlier, that was sobering, what he says here. It's going to happen quickly. It's going to be in the autumn and into the winter as well. What we know for certain is she's in Washington. Anne-Marie Horton is our Long Island hot dog correspondent here on Memorial Day. She knows famous Charlie's Hot Dogs is a place to be Memorial Day weekend on her Long Island. They're going to be barbecuing. There's going to be hot dogs, hamburgers, for key players in the debt debate, and just as importantly, for those listening to their constituents. Anne-Marie, this long weekend, what are the constituents saying to the politicians of our debt crisis?
Well, I think that's one potential issue that these negotiators will be dealing with, if that you have some of these members, either whether very progressive or very right-wing, that they need to make sure that they're going to get enough votes to pass this negotiation, which we're starting to get more details of this debt limit bill. Can they be emboldened when they come back, and does that change how they vote?
Yeah.
Because remember, Speaker McCarthy has told the House that they will have 72 hours for any legislation to read it. So if we were to get an agreement today and they have 72 hours, they have their entire Memorial Day weekend, whether having a hot dog or a lobster roll. By the way, we'll talk about John's rudeness about the Hamptons a little bit later. But will they come back emboldened? And would they want to potentially ask for more, whether it's pushing back on the White House, if you're progressive and not liking some of the caves they had to make, or if you're part of McCarthy's caucus and you already voted for a bill and you liked some of those deep spending cuts, is this going to be too easy and you're going to want to see more?
Yeah, I look, Anne-Marie, at the idea of coming back, and I think there's been a media frenzy, no fault of anyone's, to look at 5, 6, 8 people. Greg Valliere this morning makes it really clear this isn't about a debate of 5 or 6 or 10 people. It's 100 on one side and maybe 100 Democrats on the other side. There's a lot of people here to play with to get to an agreement. Am I right on that?
That's exactly right. To actually get the deal through, there needs to be votes on either side of the aisle, which is why, as you look at some of the contours of the details coming through, you can see where there are wins for the left and the right. The issue, though, and Joe and I have been speaking to lawmakers every evening on balance of power, and last night, the latest was Representative Seth Moulton. I said, what are you hearing? What's in the agreement? And he says, you know, I don't really know right now. They have been keeping this very much so in a small circle in terms of hammering out the negotiations and really under cloak and daggers before they release this text. And then they're going to have to start whipping the votes. If they get it through the House, a big issue could potentially be the Senate, because one senator has a ton of power to really gum up the works and make this very long, difficult, and cumbersome. And that could be difficult if we're approaching, obviously, less than a week, the June 1st deadline, where the Treasury Secretary says they can run out of cash as soon as that date. And already what we saw from Senator Mike Lee of Utah yesterday is he says if there's not substantial spending cuts, I'm going to make it difficult to get this passed in the Senate. And that's where you're going to have, like, Leader Mitch McConnell really have to come and make sure he can get the Republicans in line to get this over the finish line. It's going to be difficult, though.
You mentioned a couple of names. Going into the weekend, then, if we manage to get some contours of a deal, an agreement, a framework, whatever it might be, who are the names to watch, Anne-Marie, beyond this weekend?
Well, I think some of the names to watch is the group, the Freedom Caucus, like Chip Roy of Texas on the House side. That group has already sent McCarthy a letter saying, please hold firm on the deep spending cuts. And then in the Senate side, it's really the likes of Senator Mike Lee of Utah, also Senator Ron Paul. These individuals we have seen try to use the filibuster, try to not make it easy for Senator Schumer to get something through very quickly. So even if they're able to come up with a deal, that is really the first part of the hurdle of getting this over the finish line. It's a positive step. Goldman Sachs' Alec Phillips and Jan Hatzius are saying they could see this happening today, which means we could see a vote as early as Tuesday in the House, but it's not smooth sailing.
Okay, the floor is yours. We have the time.
Anne-Marie, this is real simple.
She wants to have a rant about the Hamptons. Give her a chance.
Anne-Marie, educate young Pharaoh here on the lobster roll at lunch.
Exactly.
I mean, if you're going to go to lunch and have the lobster roll, first of all, it's going to cost you $60, John.
Right.
To have a lobster roll. Go, Anne-Marie. Lobster roll.
It is quintessential. Also, if you have celiac disease or any other dietary issues, they do a lobster roll on a gluten-free bun. It's a must-stop of the summer. And John clearly has not been, because if he has been, he would not be sitting here and just ragging on the Hamptons.
John has been.
He needs a weekend out there.
Believe me,
Tom
John has
should take
been.
him out.
John has done a Memorial Day weekend in the Hamptons. Saw the price at the end of it and decided we won't be doing that again. AMH, thank you. Anne-Marie Jourdain, Down in Washington, D.C., wishing she was somewhere else, clearly, based on how that conversation went.
It's going to be a remote from the lobster roll. It's a sign, John. It says a lobster roll, and above it says lunch.
I do love a lobster roll.
And nobody calls it the lobster roll. They call it lunch.
I do love a lobster roll. Let's put it that way. I do love that.
They were more consistent years ago. Now everybody's trying to do their own little thing, so you really never know what you're getting when you walk.
Usually I order an extra bun because you get so much lobster here in the roll.
Yeah, I agree with that. But the big thing is it warm or cold? Is the first order condition.
Oh, toasted bun.
Toasted bun,
yeah, it's
but
be
then
a toasted
cold
bun.
Lobster, or do you do the hot butter thing?
No, I don't mind a cold lobster in that. No,
my answer is if someone hands me one, I say thank you.
I would say thank you.
Thank you. That's
well.
very good.
This weekend, though, all about sport. Monaco, Formula 1.
Oh, seriously.
Juventus, AC Milan.
The Colonial.
The golf is on.
Yeah.
Very cool.
Michael Block, last place.
We've got the playoff for the Premier League place for promotion.
And Coventry City. I mean, nothing. I mean, we should have asked Ricardo about Coventry City.
We should have asked. I'm sure he would have had a lot to say from New York. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Equities up, going into the weekend. The open about 2 hours away. Your equity market shaping up as follows: on the S&P 500, positive 0.2%. On the Nasdaq 100, positive another 0.4%. We just add some more weight to this rally. Year to date, the Nasdaq 100 up 27% and some. You can thank a couple of names for that. Meta, you can thank NVIDIA. NVIDIA flying yesterday, just remarkable stuff. We're talking about $150, $200 billion of market cap in a single session on a single name. In the bond market, this has been happening despite this move, with a 2-year back at 450, 449.
That is the story of the week. All the rest, it's been a crazy
10 days,
week.
60 basis point move.
Story.
10 days, 60 basis point move. Equity market not feeling good. FX market is feeling good. So check out the euro. Very close to breaking 107 in yesterday's session. 107.45 right now, trying to bounce. We're positive there by 0.2%. That's a stronger euro in the mix, but it's been about a stronger dollar. It's been about basically beating up consensus positions. Coming into the year, one big consensus position was just, I don't like tech, because tech didn't work last year. Well, tech's worked this year. So that was consensus position 1, taken out. Consensus position 2 was to get short the US dollar because Europe and the rest of the world, China's reopening is going to be great. Last month, that has been challenged.
Done.
Rate cut story, that's been challenged. What's left?
Done.
What's left?
I think what's left is this imbalance that Dan Greenhouse was talking about. And every day after NVIDIA yesterday, it is this word doesn't work, but it does work. Historic. It's absolutely historic where we are now. This is not 2001, and on and on and on.
So here's my question now, Tom, and I wonder how you think about this at the moment. Give it some thought. Spent a long time talking about U.S. equity market exceptionalism, because in the United States you had Google, you had Facebook, you had Amazon, you had Netflix, you had others as well, and those names were not in Europe. And that's why we saw this big outperformance at the index level on the S&P 500. And now we're talking about names like NVIDIA, the AI revolution. And when we talk about this, again, we're talking about U.S. companies listed on the U.S. equity market. Where do you stand now on this idea of U.S. exceptionalism, just as people were starting to think about Europe and China all over again?
This is really important. We don't have time for it right now. This will be a theme for us next week, I promise. This is really important. The distinction is profit. These companies are minting money, and even companies less successful are making profit versus the silliness we saw in 2001. There's a massive, massive distinction here of they're profitable. Now, the growth may go away, and the 30 multiple may crash down to 23 multiple, doom and gloom. But the fact is, they're still minting money on a quarter-to-quarter
You're
basis.
right, Tom, because when we talk about PEs, at least we're talking about PE, because there's some earnings there. And if you go back 23 years, that wasn't really the story in many places.
Frankly, other years like the crisis in 1998 had a little bit to do with losing money as well. Someone with historical perspective on that. This is really special, folks, on Memorial Day. It's a terrific show. The team did not mail it in. They're not saying Happy Tuesday. Either is James Kemp. He is a student of the markets with decades of experience at Eagle Asset Management down to the south side, and we welcome him this morning. James, I'm looking at the Bloomberg Total Return Index. You and I still call it the Lehman Index. Mike gets upset with me when I do that. But the bottom line is you and I had a bear market in bonds priced down that we never imagined. We've barely come back. And just in the last number of days with this new high yield, we're rolling over again. When did bonds recover to the glory that we knew 3 years ago?
Well, good morning, and thank you for having me this morning. I think it's close, and the reason that I say that is if you go back historically, I've been through 5 tightening cycles, and every time we get a tightening cycle or beginning of a peaking process from the Fed, the subsequent returns to the bond market 1, 3, and 5 are unambiguously good. And I think what's happening now is these short-term yields are attracting a lot of capital. We see it. The flows are extraordinary into the money complex. When folks wake up and realize that they can lock in north of 5% yields for the next decade plus, I think we're going to start to see the flows come back into the bond market. Suspect that we get a peaking in 10-year early summer because of some inflationary base effects. But we're pretty close to a strong buy in the bond market right now.
Are you predicting that we will see an inflation-adjusted return on yield, that we will see a constructive real yield environment like you and I remember in our youth?
Yes, I think we will, because I think inflation is trending down pretty significantly. I think the Fed's making a mistake being dogmatic about 2%. I think they're going to have to relax that. But still, a high-grade corporate credit, we can get 6.25%. Municipals on a taxable equivalent basis approaching those levels. Those are real returns and real yields. And historically, they're starting to compete with equity-like returns over the long term. So it's a good time to own duration.
Let's not bury the lead. Let's sit on it. We get the notes from the team here when we get a guest like James on, and I'm reading the notes right now. Recession likely starts in Q4 2024, James. Not 2023,
John,
2024.
Yeah, I apologize. That's a Q4 2023, Q1 2024 type
your
phenomenon.
notes are wrong. James, okay, good, because I was getting all excited about where's this extra 18 months coming from. James, walk us through the actual view.
Well, and so what I think happens is we inverted back in October, November. We typically have a 300-day lag. The other part of the equation is with the banking situation, credit conditions are tightening very rapidly. So you have the monetary side pushing rates up. You have the credit conditions getting tighter. Banks aren't going to lend when they're trying to mark their books, and they don't know what deposit flight really looks like. They're getting a grip on it, I think, now. So the tenor of the recession sort of lines up on the calendar as a Q4, Q1 type phenomena. And some of the data we're seeing out of labor is suggestive of that. Look, we had a recession last year. We're going to have an earnings recession. These are not, I think, as Tom was alluding to, and you're talking about AI and the like, recessions aren't bad things. They reorder capital. They reorder the industry. Companies now with cost of capital is higher, got to look to productivity, which is the lifeblood of growth given a struggling demographic. This ultimately gets us to a better place. It's just going to be choppy from here to the end of the year.
Well, James, let's relax a bit and kick back and maybe talk a little bit more loosely. I don't care about this word recession so much. I don't care about a group of individuals getting together at MPER and saying that was it happened. I want to understand from your perspective where you think that weakness is going to emerge. Because at the moment, I can tell you, manufacturing's in one, services is not. I can tell you at the moment, home building's certainly not in one based on the stock price performance since the last June, with that particular part of the equity market up something like 70%. AI's not in one, absolutely loving it, massive tailwind, tons of enthusiasm. Where are you seeing the actual concentrated economic weakness?
But you talk about the service sector. If you look at things like open table data, it's starting to roll over. You're seeing some pullback in consumption. As mentioned earlier, real wages, even though nominal wages are higher, real wages are actually negative year over year. Credit borrowings, credit leverage, et cetera, is picking back up. The key to all of this is going to be what cracks in the labor market. And this is what the Fed is dogmatic about. Going back to that 2% rate, the only way you get 2% inflation is with a recession and with the labor market rolling over. And I think that's kind of where they're pushing. The other thing that you mentioned in terms of where the market is sort of getting buoyed a little bit is housing. We always get a bump in housing. We always get sort of a little bounce pre-recession. Let's see if housing follows through on that or if housing rolls over a little bit. We know that we have a lack of capacity. We have a lack of supply all the way back to the great financial crisis in housing. So that is a bright spot. I just don't know how big the legs are there. We'll have to watch that.
James, I look at it, and I really want to dovetail this into all your work. And I mean, you're bringing Vanderbilt engineering here, so you certainly get the dynamics. All people want to know is, can they clip a coupon and someday get a total return? How far are we from the world of Bill Gross, of Dan Fuss and other bond giants, where you clip a coupon and you get some gain?
Well, let's remember the 10-year Treasury was 40 basis points 3 years ago. When it sits at 380, that's a massive.
Yeah, I agree. It's unusual. Yeah.
And the S&P now is got a yield of about 170. So the script has been flipped, stocks, bonds, and clipping a coupon now is absolutely in the current offerings. And I think what people have to understand is, these yields, if we do have a recession, if the Fed does at some point have to relax these short-term interest rates, you're going to have a much better return profile and income profile by locking up long-duration assets. It's counterintuitive when a yield curve is upside down and inverted, but it is historically everywhere and every time the right trade for individuals.
What about competition from equities? I mean, I get that the tech place is on fire, but it's just so simplistic to say the yield is now better than the dividend because I got dividend growth as well. When do equities compete again?
Yeah, and that's a great point. In our programs, we also use the equity side pretty aggressively. That includes, companies that are paying above market, but have that growth. And that's the essence of it. You've got to have quality. You've got to have pricing power. You want to compound that dividend over time. You don't want to simply take current yield. So those two asset classes, for the first time, 2022 was tough, obviously, for a lot of reasons, but the correlations were positive. So even if you had a balanced approach, you had a negative total return across the board. You use both of those asset classes in concert to make sure that you're getting the optimal yield. Right now, we're leaning more into the bond side because we think that's first to recover. That's first to produce better than market returns relative to dividend equity. But that's, and remember, Tom, and you know this, dividend equity is lagging now, right? If you separate the S&P constituents and you look at payers, non-payers, those handful of stocks that are leading, that are not income producing for clients, are the market story. So even though the dividend is there and the dividend is growing from a return standpoint, it has lagged bonds year to date.
Hey, James, this was great. Enjoy the long weekend. It's good to catch up. James Camphor of Eagle Asset Management. How many messages are you getting about lobster rolls now?
Oh, it's off the chart.
It's ridiculous.
I mean,
do you think anywhere in New York...
We didn't ask Daniel Ricciardo about lobster
Could we get one for breakfast? Because now I'm craving one.
I have to admit, I have to.
Luke's Lobster opens up at 11 a.m. Eastern time, I think. So you've got a couple of hours to wait for that.
Or down at Chelsea Market, there's one I go to there. That's
what's
spectacular. I can't remember the name of it, but it's like Lobster House or whatever. And they've got one side restaurant where you sit and you're responsible. And the other one, you should sit on stools if you can find one because it's packed all the time. And what I do there, seriously, folks, this is wonderful. Chelsea Market in New York, this is what it's about. First of all, their business is so huge that everything's fresh. That's the first thing. And in America, John, it's not often the case. And there'll always be one thing I've never seen before, and I will try it. Usually I hate it.
What's that?
But
give us an example.
It was like something you step on in the Philippines. You got a Palawan and, you're out there and you put your foot on something.
Just to be careful. There's a wife at home, your wife, who's not going to be too happy with that comment.
I'll try it to keep the marriage together.
Okay.
And it's usually I go down in flames, but at least I try it as well as your basic Maine lobster.
Mrs. Keane watching right now.
Can we get Gerard Cassidy on? We need an authority on this.
Up in Maine.
Yeah.
Proper lobster. Coming up next, Dan Ives of Wedbush on AI and tech. Your equity market positive, 0.2% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from budget increase for the IRS. And another Republican may be gearing up to enter the 2024 U.S. presidential race. The Wall Street Journal reports North Dakota Governor Doug Burgum is planning an event on June 7th to make a major announcement. Burgum's a wealthy former software entrepreneur who was first elected in 2016. And economists now think China's central bank will cut the reserve requirement ratio for major banks by 25 basis points before the end of the third quarter. That's earlier than they previously anticipated. This comes from Bloomberg's latest survey. They also pared expectations for GDP to 5.5%. And Cathie Wood's flagship ETF closed out its NVIDIA stake in January, missing out on the stock's recent powerful rally. The chipmaker, the world's most valuable, has added more than $500 billion in market cap since Wood dumped the shares. Wood holds NVIDIA across several of her smaller funds, but investors in the flagship ARK Innovation ETF missed out on NVIDIA's blistering rally. And Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's weighing on profits. Jacobs will become Lazard's executive chairman. Global news powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisce with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
If you look at tech, it continues to reinvent itself over and over. The latest generation is going to be AI. And I think as you look at the visibility of earnings, you continue to see a strong earnings coming. And I think that that's important because a lot of people continue to say that tech has gotten expensive. But when you start to factor in how much tech has been able to beat their earnings, I don't think it's as expensive as what people think. And I think that trend is going to continue.
Really nice to hear from Larry Adam to catch up with the Chief Investment Officer at Raymond James. He's constructive, has good reason to be. Year to date, absolutely flying on some of those names. Someone reached out on Twitter, Tom, just that restaurant you were talking about over in Chelsea Market.
Yes, yeah.
Cullen Pistol.
Surveillance
Cullen
correction,
Pistol.
folks. Before David Weston emailed in, watching this morning. David Weston said,
What did Weston
"Tom,"
say?
He said, "Tom, it's not called a lobster place. Weston's there like 3 days a week."
Oh, he goes to Cullen Pistol.
Yeah, he goes to Cullen Pistol. And thank you so much on Twitter. I had a brain freeze. What
I've
can I
never
say?
been. It looks pretty nice.
Oh,
to
no,
be honest with you.
it's spectacular. I can't say enough about it. Fresh. It's like...
I've got a brunch spot that does lobster and scrambled eggs. I'm not going to share it because at the moment it's quiet and I kind of like it that way.
Did you get it with the smashed peas?
No, just have it as it is. Just like that. It's perfect. I'm enjoying it right now.
It's really, really good.
Dan Ives with us in the studio of Wedbush, weighing in on NVIDIA's surge. He wrote recently the following. In 22 years of covering tech stocks and large cap, we have never capitalized, seen a guidance range of this magnitude on a large cap tech name, and thus speaks to our thesis that the monetization of AI for stalwarts like Microsoft, Alphabet, Amazon, Oracle, Meta, Apple, and Salesforce, Tom, is well underway in this Game of Thrones battle among tech players.
This is the interview of the day. There's no question about it. You know, he's competing with Daniel Ricciardo of Formula One fame, and Bob Dole was on earlier, and a bunch of other worthies. This is what matters, folks, because you're living the tech dream like we are, and Mr. Ives is leading the way with optimism on their profitability, their enduring profitability. He is at Wedbush Securities. In Cupertino yesterday, they saw what you saw. What does the NVIDIA 4.4 standard deviation leap mean for Alphabet? And particularly, what's it mean for Apple?
Look, I mean, this, in my opinion, it's $800 billion of incremental spend now over the next decade for big tech. And when you look specifically at the read-through for Apple, I mean, there's no better read-through, what I believe, and we'll see more at the developer conference, in terms of overall demand. And this AI revolution, it's opening up a total addressable market for these big tech players that wasn't there 6 months ago.
Is it profitable, Ed? That's at the top of the income statement. That's CapEx off cash flow. But will it be profitable?
It is a gold mine in terms of profitability from a margin perspective, because that's right now Nadella and Redmond, I mean, they're popping the champagne because for every dollar that you're going to see of AI spend, that's margin incremental 15%. Incremental margin. So I think what's starting to happen with these stocks is that Street's starting to look through the trajectory. You're looking at higher margin business, growth that's really going to be, you could really count in two hands the amount of players that are going to benefit on the first, second derivative. And when you saw from the video, it shows this is a gold rush that's real, not hype theme, maybe like metaverse, and crypto and some of the others.
So we're going into the long weekend, and there's going to be a bunch of family members of people who follow this stuff, maybe even buy it, who are going to hear of this company for the first time. It's been performing really well for a long time, but for a lot of other people, they might not be familiar with this name. It's not exactly a household name outside of Wall Street. Can you run people through what they actually do and what they're leveraging here?
So when you think NVIDIA, in my opinion, I view it as the hearts and lungs, the epicenter of really, from a chip perspective, of AI and what I'll call big data technology. Nothing works without NVIDIA chips. Microsoft, Google, Amazon, it's all feeding off NVIDIA. And that's why I kind of view as the foundation, the best derivative in terms of what you see as a forecast, what's coming down the pike 3, 6, 9 months from now, is what you saw from Jensen with the $4 billion guidance rates. Because that now is going to feed into Microsoft, it's going to feed into big tech. And I think, in my opinion, it's not just about the guidance. This is a historic day that shows the AI revolution. I believe it's probably the biggest transformational tech trend I've seen since covering tech in the late 90s.
That's a lot of hyperbolic language. So let's strip some of that down and talk about valuations. When it comes to momentum in names like this, how relevant are valuation metrics, given the story that you're describing and this big future that you're expecting?
I think when you become laser focused on valuation over the next year, you would have missed basically every transformational tech stock the last 15 years. So in my opinion, to look at that, it's looking at the leaves instead of forest through the trees. But I look at it like you could look at an incremental $5, $10 per share of earnings power when you start to trajectory it out. As Tom and I have talked, on Apple, I mean, I view Apple right now in some of the parts. I could argue that AI adds another $30 to $40 per share to the Apple story.
What's Apple doing with AI? What's that about?
Well, I think we're going to see the developer conference because ultimately they're going to really, right now, the billions they've been spending on AI, it's going to be another use case that you're going to be able to deploy within their install base, within those 2 billion iPhones.
But what are we talking about? Siri on steroids? What are you describing here?
So from an AI perspective, they're really going to be, from a user perspective, be giving users the ability to, on the services side, from cloud, from music, from TV, to more and more of the devices, cross-pollinating between different devices that you're going to be able to get different information within the actual Apple user. And I think what Cook's going to talk about is AI could be really another foundation, another monetization of the Cupertino growth story.
You're the Uber bull. You got a lot of people taking shots at you. And any research report, halfway through, there's 3 paragraphs on total risks. What's the lead total risk paragraph to AI?
Biggest risk is basically what I view as the U.S.-China decoupling, because you could argue that that's a risk from an AI perspective. And two,
is Taiwan a risk because this stuff is actually made off TSMC?
I mean, look, I was just in Taiwan a week and a half ago. I think right now it's bark worse than bite, in my opinion, in terms of as an overall risk. Biggest risk is just companies don't spend. They had to hype the economy. Ultimately, they're going to. But as of right now, what we're seeing is, I think this is right now a green light to own tech, in terms of what we view. And I think this is just, I think the start of it, I think tech's being up another 10, 15% rest of the year.
Apple EBITDA margin 32 cents on the dollar. What does AI do to that out 5 years?
That basically increases by about 500 bips.
So what is it? Some of the parts, did you say up $20?
Some of the part, you can say Apple, it could add $30 to $40 per share as it all gets monetized into the base.
It's amazing, isn't it? It's easy,
I've never heard this.
Easy to sit here and just be smug. I reflected on this a couple of times in the last few years and once more recently. There's this great exchange, Dan, and I'm sure you've seen it, between an analyst on Wall Street, bullish on the internet, and a journalist from 60 Minutes. And the journalist from 60 Minutes is sitting with this analyst on Wall Street and saying, Amazon's worth more than Sears? Does that make sense? He's so convinced he's right about Amazon just being this bubble and Sears being, what Sears was. And I'm just trying as hard as I can to be open-minded about this moment at the moment, Dan. Any reflections on this period and that one?
I mean, this period reminds me of what I viewed coming out of the Apple launch with Jobs in 2007. and it reminds me of my visits with e-commerce companies in late 90s in terms of, so I would say there's only 2 other times that I would compare to this, and I believe that's why Nadella, that's why Cook, that's why Jensen are going after AI.
Your buy recommendations build half the houses in the Hamptons. I mean, anything over 5,000 square feet, they got a brass plaque on it. Thank you, Dan. As well, would you like to weigh in on the lobster roll debate in the Hamptons here? I mean, you've got a little bit of experience at that.
I do. I'm super bullish on the lobster roll in Hamptons, but I continue to believe the best lobster rolls are a 617 area code.
So up in Boston, you like it with the hot butter or the cold?
I do. Look, and even though I'm a Long Island guy, I'm more of a 617 when it comes to lobster rolls.
John has no idea what we're talking. I mean, you don't have to go to Maine to get the proper New England
roll. I've had
rolls.
lobster in Boston. I'm very well traveled. Thank you.
But I will say, Farrow at Durgan Parks years ago. Could you imagine what the waitress would do to John Farrow at Durgan? Your accent, who are you?
But the guy's a legend. It doesn't matter where the lobster roll
Thank you, Dan.
place
You
is.
tell him. You clear that up. I just got this message from Art Vanderlei on Twitter, and thank you for writing in, because a lot of you have given us recommendations.
Oh, are we
now
getting
for Weekend
recommendations?
Lobster Landing in Clinton, Connecticut.
Oh, yes.
Lobster Landing.
Yes.
Looks like this little shack by the water. It looks fantastic.
Jonathan emails in Surf Avenue, Coney Island. I'm actually down there a couple times a year. Afterthought forces me to go down. Nathan's, there it is, 11224.
Go for it,
And
Dan.
there's some under the radar lobster roll places in Hampton Bays, not in the core Hamptons. You know, so some places are a little off the grid out there.
You can write a research report on this?
I could, and maybe
expense the whole thing.
and maybe a ChatGPT angle as well.
Very cool. Let's make that happen.
ChatGPT
Hey, Dan, it's good to see you.
lobster
Dan
roll.
Ives of Wedbush. Going into the weekend with some of these names ripping. Mike Wilson, Morgan Stanley, with a different perspective on this equity market. That conversation coming up shortly. Looking forward to that. From New York City this morning. Good morning. Equities higher.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction or they invest for if they invest for the right reasons, just keep at it.
You're always flying blind in this economy.
If you look at the performance in U.S. equities, I think there is a huge amount of dispersion within that.
I still like the equity markets longer term for people that have a long-term horizon.
You cannot be underweight stocks here.
This is pretty classic late cycle behavior.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bramo off today. It's like a three-island tour for the Memorial Day. Having lobster rolls at all three islands as well. We're having fun today, but as we said on Wednesday, you know what? There's some real news flow going on. On a cautious view on the market, Michael Wilson will join us from Morgan Stanley here in a moment. And John, pushing against Wilson is NVIDIA yesterday. And just moments ago, futures up 11 as well.
Well, it depends how you slice and dice the equity market. Dan Greenhouse of Solus was sitting just over there next to you in the last hour, and he talked about the S&P 495. The S&P 500 doing its thing, the NASDAQ 100 doing its thing. But when you take away the big players, Tom, underneath the surface, there's a bit of a struggle. I think we're going into this long weekend stateside, and there's going to be some conversations around the table with the family about perhaps the fear of missing out as the AI revolution starts to take hold. Michael Hartnett of BofA does a great note weekly on a Friday, and he talks about the zeitgeist of the moment. He said, if you're going to lose your job and be replaced by AI in the next few years, might as well own some AI as a hedge note. And that's kind of the zeitgeist of the moment, according to Michael.
In my take, there's a little bit of silliness going on here, and I can't identify what's the silly part and what's the genuine part.
Agreed.
But my part is Ives was just sitting here, and he's like a piñata. The hate mail on Dan Ives is tangible. The fact is he's enjoyed Apple from 100 to 170, and the point here is profitability. I don't hear anybody saying this will be non-profitable.
I want to make it even more simple. The point for me is use case. I want to understand, Tom, when people talk about Apple and AI,
I'm not there.
What's the use case? I'm trying to understand.
I don't get it.
Dan did his best at explaining it. I wasn't quite there.
Nope.
I'm doing my best to stay open-minded about it. If it is this big revolution, then I think we need to be. But when we start to make stock selection calls off the back of this story, I want to understand use case.
I would suggest, does it embed revenue growth and does it come down the income statement? But the real question is, does it roll over to the rest of the American economy, increase productivity? And that's the separation in equity markets we're going to talk to Mike Wilson about in a moment. Mike Wilson is riveted on Zevis and the policy people at Morgan Stanley and Washington. A sleepless weekend for Morgan Stanley policy.
Do you think there's actually going to be a sleepless weekend anywhere down into D.C.? And there's debt ceiling tobacco?
No.
The
It's not a
contours of a
toxic
deal
brew.
coming together?
It's a ballet the president knows well. The thing here, and this is not about the politics, Democrat and Republican. It's about, we got a president who's been through this, what, 20 times?
Yeah, plus. He's been around a long time, hasn't he?
Yeah.
Seen it a few
That's
times.
weird. Data, futures up 11. They've turned here moments ago. I got a VIX 18.73.
I've got the S&P up 0.25% on the S&P 500 futures with a lift. Yields dropping back, down 3 basis points. Around 380 though, 378.67. Just amazing to see the 2-year back up at 450 right now, Tom. 2-year yield down by 3 basis points on the day, but we've done the work the last 10 sessions. Back through 4.5% at the front end of the curve.
Right now, and this is important, you need to reset for the weekend. You need to reset for the second half of 2023, and particularly if you've not participated in the 7 tech stocks. Mike Wilson will brief on the caution that is out there. He is at Morgan Stanley, their U.S. equity strategist, and has been, I'm going to suggest, cautious through thick and thin of this pandemic and forward. Mike, what are you writing this weekend to recalibrate a cautious call?
Yeah, good to see you guys. I mean, our call really hasn't changed. We're very disciplined on price. And as you know, we got tactically bullish last fall at 3,500 because that was a good price. And now we're, of course, back to the high end of the range, and that's not a good price. And that's at the S&P level. That's not really what's been interesting over the last 6 or 7 months. As you know, what's been interesting is what's going on under the surface. I would say in the fourth quarter, that was a very hated rally because it was led by kind of the old economy, financials, industrials, energy, materials. It was all based on, the China reopening story, which was legitimate. And technology stocks obviously disappointed, and they did not trade well in the fourth quarter. So it was a hated rally because that's what people own. Now, of course, the S&P is trading at the same price it was in early December when we got cautious again, and tech is obviously going to the moon. And now this rally is loved because this is what people want to buy. This is what people want to own. It's a lot more interesting and, kind of exciting to own AI and technological revolution than it is to own those old economy stock is, well, why do I want to own this long term? So it's just an interesting development. We would characterize this as the bear market is continuing. Okay, this is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, probably sell them at the wrong time. And we think the overriding driver, okay, of this year's rally has been increased liquidity. Liquidity has improved dramatically, both on a global scale, and the weaker dollar has helped. That's going the wrong way now again. And then, of course, ironically, the banking failures that happened in March led to an injection of liquidity from the FDIC and the Fed. And we think those things have really conspired to drive the market. I mean, nobody talks about the fact that crypto is up 60% this year, okay? And then the next one, of course, is the tech world. So this is what's going on. We think that the fundamental case does not support, where stocks are trading today, whether it's at the index level or at the single stock level. And the second half is going to be a bit choppier and probably downward in the index.
Mike, let's just talk about the index a little bit more, and great to have you with us as always, particularly going into the long weekend. Mike, you really started the debate this week on this program, and we reflected on your note from over the weekend into Monday when you said the following, that there are many technical signals that conflict with the idea that this is the beginning of a new cyclical bull market. There was a short list after that of those signals, and one was extreme narrowness, poor breadth. We presented that to Savita Subramaniam, a peer of yours over at Bank of America, and she said narrow breadth is not a precursor for doom and gloom. Mike, I just wanted to give you the opportunity to respond to that. What is it about narrow breadth that you think signals something at the index level?
Well, I think you could debate this one way or the other, meaning when you make a market low, you typically do have severely negative breadth. That is a good sign. However, the index is usually down with it. So we think where we are is the index is telling you things are rosy, things are fine, and the breadth is telling you otherwise. And then when we put our fundamental overlay on top of that, which is, we're way out of consensus now on the earnings front, then we can make the conclusion that the internals, right, the breadth is being one of those, but the internals and the leadership is telling you that growth is going to be a problem in the second half of this year. Whether that's an economic recession or not, we think it's going to be an earnings recession that's way worse than what people are currently modeling. And look, I want to go back to the beginning of the year. You guys are good readers of our reports. You remember at the beginning of the year, I was somewhat nervous that everyone was in the same camp at that point. Our view is very consensus on the fire and ice, the tightening and then the slowdown. And so we were trying to figure out, well, how could everybody be right? That doesn't work. And so what we've done now is we've worked off that oversold condition. And more importantly, now I would say the consensus is actually optimistic on earnings again. And that's just where we completely disagree.
So, Mike, can we just build on the challenge to the index level, retesting the lows of last year, given the muscle of 5 or so names doing just ridiculous things, up 100% plus, Meta, Nvidia, etc. Is that a big enough challenge to the view that we can retest the lows of last year?
Well, not necessarily, not at all. In fact, it kind of sets us up where it's probably inevitable now, because what's happening is you're basically forcing people into these stocks at bad prices now. The valuations last fall on these stocks in particular was extremely attractive. And if you look at the performance of all of these names, with the exception perhaps of the one this week, which, earnings are going up, the earnings are not driving these stocks. It was 100% multiple expansion, which goes back to our liquidity question. So look, the price is wrong in our view, because the earnings are probably going to be wrong for most of these stocks, not all of them, but most of them. And so from here, we think it is still a stock picking game. And of those 6, 7, 8 stocks, my guess is 2 of them will probably be okay, and the other ones will not, because they are the economy. Okay, they can't avoid the economic slowdown and the top line slowdown that we see in the second half of this year.
Mike, maybe a bit off your remit, but I got to go here. Just percolating in the zeitgeist into June is the once again debate of active versus index usage in the equity market. Give us your update on the value of active versus the value of index investing.
Really interesting confluence right now, because you could argue both are working at the moment, right? I mean, having the right stocks in your portfolio has been really the only way to make money this year. The problem is that those stocks are such a big part of the index. The passive person can say, look, my passive strategy is working as well. And so we still think active will have a comeback here as we go through the next couple of years. It already is to some degree, but boy, it's been, the market, once again, the market is doing a very good job of kind of fooling us into whatever we want to believe. We think active will be the place to be for the next 2 or 3 years. It's going to be a comeback there.
Mike, dovetail this with Ellen Zentner. Take the recession call of Morgan Stanley and dovetail into your caution on equities.
Yeah, so Ellen and team, I mean, they're not looking for a hard landing. What they are looking for, though, is a very sluggish economy. So it's sort of 0% GDP growth.
Right.
Now, that's fine if you still got price. Our view is that 0% GDP growth will lead to bad price. And we're already seeing that in the goods sector. And then we've done some consumer work recently, which is we're starting to see signs that even the high end is starting to pull back on spending intentions on services. So, services is 70% of the economy. It's, goods are 70% of the S&P 500 earnings. So in other words, the economy can stay kind of at zero, but that's not going to be a good outcome for S&P earnings in our view.
Mike, do bears eat lobster?
Well, we can't afford it because we're bearish. I mean, lobster's expensive. Plus, I'm cheap anyway, so
Mike, we'll try and hook you up with one. Thanks for appearing this morning. We appreciate it. Mike Wilson there of Morgan Stanley.
We got to do lobster and hot dogs.
Honestly, the feedback is ridiculous.
Who cares about economics, finance, investment, or that? For the price, we forget about this. Cullen Pistol in New York, $35 for lobster roll. Beals, Gerard Cassidy, Beals is in Portland. There is a plaque, the Gerard Cassidy Memorial Stool at Beals. It's MKT is the price.
So what we need is Michael
$42.
O'Leary to come over here and start Ryanair, so we can fly from New York to Maine for $15.
Lunch with Gerard.
It'll be cheaper to fly up to Gerard and get a lobster roll there than get a lobster roll in New York.
Money.
Okay, 8:30 Eastern Time. Don't miss this. Tom Keen's sitting down with Megan Green of the Kroll Institute and future member of the Monetary Policy Committee at the Bank of England. That conversation coming up.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. Default worries are intensifying, though, in the U.S. as the Treasury's cash balance drops to its lowest since 2021. Data show it fell below $50 billion on Wednesday as the debt ceiling standoff does continue. The Treasury's bank account has been under downward pressure recently as the government implements measures to avoid breaching that $31 trillion debt cap. And wealth bankers in Asia at UBS and Credit Suisse will get a rare incentive for bringing in new money. They're going to get a cut of the cash equal to 15 cents for each $100 of new client money. That's according to people familiar with the matter. Asia was once a key battleground for the Swiss rivals, but they're now trying to show clients stability after that emergency merger back in March. And shares of Marvell Technology are surging in pre-market trading after the chipmaker said it expects sales of AI-related products will at least double this year. Adjusted earnings for the first quarter also beat estimates. It's the latest chipmaker with a rosy forecast on AI. Remember, NVIDIA's market value jumped past $930 billion on Thursday. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. The debt ceiling deadline closes
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
I don't think we're in that world where equities is the no-brainer play anymore, especially not when you have such interesting yields in fixed income. And I think for investors, that's probably the consideration. There is money definitely on the sidelines, but I think the days of just buying equities blindly because you had easy monetary conditions are behind us.
That was Diana Amoa, the CIO of Long Buy Strategies at Kirkoswald Capital Partners. Great conversation yesterday. This just in from Mohammed Al-Arian, reminding us, TK, that we have Frontier and Spirit Airlines to take us places that we don't need.
Mohammed Al-Arian is flying Frontier. When was the last time Mohammed I can honestly say, for full disclosure, I've never been on Spirit.
I've been on Ryanair,
it's a great airline.
EasyJet too. I've never been on Spirit or Frontier.
Why isn't Joe Biden talking to O'Leary? Oh, come on in, you know.
We've got Mohammed on in about 40 minutes.
Oh, we do, do we?
Yeah, we do. We do.
Good.
We as a network, as a company, we have.
Won't get out of bed for
Mohammed.
me. Know that for certain.
On London time, Tom, over in Cambridge.
It is an important day. There's a lot going on here. Data. We're going to lobster chat in a minute. We brought in a lobster. She's our chief lobster roll authority, Shonali Bassick, with us. But on a serious story today, which harkens back to leverage in hedge funds, and we're going to talk to her right now about risks and shadows and opaqueness that's out there from 2 years ago, or might I suggest July of 1998 as well. I'm going to go right to the top of your story. How leveraged is the leverage discussion of a bond transaction?
Listen, a lot of these trades are very significantly levered, sometimes 50 to 1 or more. And the reason this was always okay is because it's in the treasury market. This is the most safe liquid market in the world.
Until it moves.
Until it moves. And now it's moving quite violently, as we know. And so we know that ever since the LDI blow-ups that we saw earlier in the UK, banks have been asking hedge funds to cool it, essentially. They've been asking for more margin. They've been reducing risk. But listen, a lot of this leverage comes from repo markets, sometimes sponsored repo, which is money market funds. So there are a lot of worries here under the surface in treasury markets.
Gensler wants clarity here. We got opacity in that. We understand we had a banking crisis because we really didn't know what was going on at SVB. Do we know what's his name, Griffin?
Ken.
You know, he's going to buy like the Miami Marlins and the rest of Florida as well. Yeah. Ken Griffin, do we know what he's doing? Do we know his 50 to 1 leverage on these transactions?
Listen, these are called basis trades. They're fairly simple trades that arbitrage the difference between treasury futures and spot. Citadel, Millennium, Exodus Point, Capula, Alphadyne. These are some of the biggest players in this space. Our sources say that Citadel is not as levered to the trade as they have traditionally been in the past, or as peak leverage has kind of gone before. But we know, guys, not only has this caused major losses among hedge funds in the past, the reason it's a problem is it's caused the Fed to step in. People forget that in 2020, the Fed has had to step in on this trade. And
are they stepping in 2023? Do we know that within the reporting?
I think that's a lot of the problem here and why there's a worry here. There's a kind of implicit understanding in the market that the Fed does step in. They have to step in. The hiccups in the treasury market are not of the making of the hedge funds this time. It's of Washington.
Yeah.
However, it's not clear that the Fed wants to bail out hedge funds again.
Just to be clear, why would the Fed have to step in? And why would that be called a bailout of hedge funds?
Well, it's interesting because in 2020, when the Fed stepped in, there was the pandemic going on. So it was more about the pandemic and less about the hedge funds. What's less explained is 2019, when they had to step into repo markets because of more drastic movements. And again, a lot of these hedge funds were levered towards the trade. This time around, if there were any major issues, you could say, well, we didn't cause the Treasury market volatility and we didn't cause a downgrade.
I want to make this clear. Are there major issues now, or are we reporting that there seem to be shadows from 2 years ago?
No, there are issues now. There are issues. The reason there are issues is not that these trades are blowing up right now or anything like that. It's the issue that what underpins these trades is repo leverage and this idea that if there were any potential downgrade in the Treasury, then all of the collateral underpinning these trades are not worth what they were yesterday. So there are real issues in the market that the debt ceiling does exacerbate to some degree. But again, these are highly levered trades and a lot of the leverage is bilateral. So it's very, very opaque. Guys, changes have been planned or talked about since the Obama administration. It's not really changed much at all. And when you see such violent moves in Treasury markets, that's when banks and regulators start to ask questions.
Is there a danger, though, that we're blaming hedge funds for something that is the responsibility of politicians in Washington and poor policymakers at the Federal Reserve?
It's not blame per se. This is kind of a market structure question. There have been a lot of calls in recent years to make this market more transparent, and it hasn't really gone that way. And so when we're thinking about what happens now and the potential risks, I think, even if you're all clear, we have to remember that this is a market with a history of blow-ups. This is a market that there have been asks for change. And, by the way, it could be forgotten about if they have a debt ceiling compromise here and some of these issues.
I get the rating decrease idea, even on a 50-to-1 leverage. And I have the clearest memories of learning how you get from 3-to-1 to 12-to-1 to 22-to-1, whatever it was with LTCM. But to John's key question here is, well, what's the so what here if they're just hedge funds and if they lose money, why do I care? If Bobby Axelrod goes under, who cares?
Listen, you're making the hedge fund point, which is, hey, we don't see blow-ups.
I'm just trying to get on billions here. Play with me. We'll get on billions.
Yeah, no. And
help me here. What's the so what here if the hedge funds get hammered on this?
Don't forget that the Fed has had to step in before. That is the problem. If there are moves that are already violent, that are then exacerbated because you have a ton of leverage in a market as well, and that creates moves that are more violent in repo markets, which, by the way, matter to markets that are not just hedge funds, that's the worry here, right? Toying with a market that is supposed to be the underpinning of the entire capital market.
Shonali, as our chief Hamptons correspondent, seriously, she's the one with the most distance here. What's the distinction between a lobster roll in Southampton versus way out on Montauk?
Wow, there were a lot of restaurants recently purchased, weren't there? You're probably paying a lot more for that.
Big season in the Hamptons for the hedge fund crew?
Yeah, I would say so. Obviously they're trying to get out there, but remember, people expect deal activity to come back after we have this debt ceiling issue resolved and after the Treasury general account build and all these arcane things that we're talking about.
That's the hope.
The debt ceiling issue.
Hope, but
listen, they're staffing up. If into the summer, staffing levels are going to stay high. People are worried about things guys, there's so many risks under this market. That's what this story is telling you. And regulators and bankers are asking about it. So the idea of taking a whole lot of time to chill out this summer is not a popular idea.
I just don't get the Hamptons thing. I don't think I ever will. I just don't get it.
I'd rather watch paint dry. I'd have to be honest with you.
I just don't get
it's
it.
Not my...
Not your scene.
No, you're out there 3 out of 4 weekends of the month.
It's not Shonali's scene. I just don't get it. I don't get it at all. Fly to Europe,
well, that's a different story, John.
If you've got that kind of money, if you've got that kind of money,
that's happening.
Or even if you don't fly to Europe.
Yes.
But what about for mere mortals that can't fly to Europe, once every 4 weeks, once every 5 weeks?
Spirit Airlines.
Well, they've probably not got $100 million houses in the Hamptons either.
You go down to New Jersey, right?
What's wrong with Jersey? You used to go to the Jersey Shore.
It's a different thing.
Different vibe?
Yeah,
This is where I'm from.
Goes back to Gatsby.
What's the Jersey Shore Hamptons distinction? That's the question you should ask Shonali. She's a New Jersey girl.
History, what?
I like to say it's pure grit.
That's the difference.
Personality, grit, music.
Okay, keep digging. Music, true.
Music, big difference.
Springsteen.
Big difference. Big difference.
Very cool. Shonali, this was great. Appreciate it.
Shonali, thank you. A
Hedge
very
funds.
important report.
Offended a couple of people along the way. Why not? You know? Okay.
Important
Mohammed,
story.
coming up, 35 minutes away. Looking forward to it. Mohammed Al-Erin of Queen's College, Cambridge. Looking forward to that. And we'll catch up with Seema Shah of Principal Asset Management as well. Krishna Mamani of Lafayette College going into the opening bell. To close out, I've got to say, Tom, you know what? Things got interesting again this week. Globally.
Well, I would like to suggest
Guilt,
team surveillance predicted
inflation in the UK, the moves in the Treasury market, AI.
Yeah. What am I watching?
Breakdown in the euro. It's interesting.
We're not talking Japan. Euro yen 150.23. I mean, at resistance. Interesting to see what they do with the economics of Japan over to YCC.
I'm going to run if I don't see you, TK. Have a nice weekend.
Yeah, well, you know, lobster roll breakfast. We can do that.
I'll see you soon in about
Red Oak keeper of the
35 minutes
Amex would
time.
love it. You know.
They're going to pay for this.
What about this? $200?
Yeah, yeah,
This is
about that.
Bloomberg. Good morning.
Research.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg Reporter surveillance. Good morning, everyone. Lisa Abramowitz, Jonathan Farrow, and Tom Keene. Thank you so much for the response today. We're having fun on a Friday before the celebration of Memorial Day, the remembrances of Memorial Day as well. We hope you have a great weekend. The celebration in the market is simple. Futures up 8, doing better through the early trading. You got to believe smaller trading today. Dow futures up 50 points. I did that for John Farrow. The VIX 18.52. There is 2 Bloomberg screens of economic data through the morning, with Michigan coming up later, a Kansas City statistic. Michael McKee has the unenviable task of literally looking through 20 items and the 4 pages of data behind each of those 20 items. What do you see, Michael McKee, this morning?
Well, I see the durable goods orders out right now, but we don't have the personal income numbers yet, because I think everybody is hitting the internet at the same time. There we go. Personal income, 0.4%. That's better than the 0.3 last month, and it matches the estimate. Spending, though, stronger than anticipated, up 0.8%, compared with a flat reading in March. PCE deflator. This is the news the Fed is watching. Is stronger. 0.4%. That's up from 0.1 last month, and it's stronger than the consensus forecast. Puts us at 4.4% for the headline number over the March number of 4.2%. Core is up 0.4, which is stronger than anticipated. Yes. And that puts us at 4.7% from 4.6%. And so if we're just looking at these PCE numbers out of this release, you're seeing a lot of pressure being generated on the Fed to maybe raise rates one more time. We'll check in on what the bets are on WIRP, the Bloomberg function, in just a moment. Durable goods orders up 1.1%. That is compared with a 3.3% increase in the month of March. Right. Durables ex transportation down 0.2. So we probably got some Boeing in there. Capital goods orders, non-defense ex aircraft, 1.4%. That compares with a 0.6 drop. So one of the things in the first quarter, Tom, that was a concern was that business spending had dropped off. And when we got the revision to GDP yesterday, we saw business spending raised a little bit, and this looks like it's contributing to maybe a return of business to the world.
Take a breath. Look at the data. This is really tough. This is what McKee does better than anyone in the world, folks. It's like 3 days. It feels like 3 days of economic data on steroids. And what it is the markets were going to react. Moments ago, the 2-year yield to 4.56%. Critically, this is not about the intraday chart. On radio, we're showing the intraday chart, and yes, up it goes to a 4.55. Far more importantly, we're getting up to where we're breaching the high yield that we saw in the 2-year of a number of days ago. The curve inversion is further. We go to negative 75 basis points, a difference in yield between the 2s and the 10s. Critically, the 10-year real yield adjusts higher, 1.56% there. These are all global Wall Street key data points indicating a little angst out there about the stickiness. Michael McKee, from where you sit with 15 major data points in Michigan coming up, is this a sticky inflation sum of data?
Oh, sure. And it is not particularly good news for the Fed. One number to give you beyond where we were, 4.1% is the personal savings rate, drops down from 4.5%. So Americans did dip into their savings to spend what they spent. And of course, as we mentioned, spending was up on the month by 0.8 compared with just 0.1 in March. This is going to be a problem for the Fed. This is their indicator. This is the one that they watch and they base policy on, and it is going the wrong direction. Now, it's not that they didn't think that would happen. They expected some volatility and lumpiness in the numbers, but about half of them or more said in the minutes and have said in speeches since then that they're going to probably need to raise rates more. So then the question becomes, do they do it in June or they do it in July? And this kind of moves up the timetable, one would think, to perhaps June.
And what's important here is the vector. I'm not going to do this because we'll waste time getting to Megan Green, and we don't want to do that. But Mike McKee, really simple here. We peaked on PCE deflator year over year, 5.46%, I'll say, in early 2002. And I'm sorry, a vector is in place to disinflation there. but is it tested this morning? Is the vector really under threat of disinflation?
Disinflation, it's not under threat at the moment. I mean, we're looking for that kind of progress, but so far we're not getting enough restraint from the Fed's interest rate increases to get us there. And Tom, I told you I'd look this up. We're now up to an 86% chance of a move by July, a 46% chance of a move in June. Those are both significantly higher than they were before these numbers came out.
Michael McKee, thank you so much. Futures up 3, Dow futures up 21 as well. As you know, over the years, I've made clear the Bank of England simply does it better. Maybe it's because it's a surprisingly new public institution versus the Fed and all the codified history of the Fed. But what they do more than anything is they take in people with different views. I think of Adam Posen, now at the Peterson Institute, IIF, I'll get it right, International Economics, Peterson International Economics in Washington. I think of David Blanchflower at Dartmouth. And now they go brilliant in a number of months by bringing in somebody really original in economic analysis and policy discussion, Megan Green of the Kroll Institute and, of course, of Brown University. She will join the Bank of England, and obviously with those constraints, she cannot speak about the Bank of England. She cannot speak about the United Kingdom. We checked with her entourage. She cannot speak about the future of Tottenham Spurs, and she can definitely not speak about the politics between Cambridge and Oxford. Is just too deep and too dangerous to go to this morning. Megan, congratulations on this hugely important appointment. I wanted to talk today about the American economy and the certitude we have of guessing vectors of inflation. You're expert at the history of the study of that. Can we actually game a vector of inflation?
Yeah, look, the inflation data was always going to be bumpy coming down, and that's what we're seeing. But I think what we can gauge is sort of underlying trends and look for signs of persistence of inflation in the U.S. The core capital goods data that just came out surprised on the upside. That's about 70% of fixed investment, so that suggests that demand's pretty strong in the UK economy. And core PCE was stronger than many had hoped. So, I wouldn't read too much into one data point, but it does suggest that the Fed isn't done. So even if the Fed does end up pausing, I don't think it's finished here. We've seen that corporate earnings have been pretty strong. That means that there's a lot of labor hoarding that may well continue, keeping the labor market strong. That, again, keeps demand strong, keeps upward pressure on inflation. So I think that the Fed's got more work ahead of it.
One of the Megan Green realities is plain language. You actually speak in English. Thank you for that. That'll help you with the Bank of England. You speak of this as a weird time in history. Define that phrase.
So it's a weird time in history, just given the successive shocks that we've had on the economy between a pandemic, a war. A lot of the indicators aren't really responding, particularly to tightening of monetary policy, as one might expect. And the labor market here is a great example. The labor market is holding up freakishly well, given how much aggressive tightening there's been in the U.S. And as I just said, that keeps demand really strong. And so the Fed's trying to sort of kill off demand to bring it back in line with supply so we can see price stability. But it's just not transmitting, monetary policy is just not transmitting into the real economy as we expected it might.
Dominic Constant was on earlier with Mizuho, also out of Oxford, and he made very clear there's a partition between demand-driven inflation and supply-side inflation. Obviously, that's a pandemic inflation. Are we still living the pandemic in the wall of data seen in America this morning? Are we still living the pandemic in our funny savings ratios and what that means for income and spending?
I think we are. It's a bit too early to say how long that will actually last, but we're seeing it in consumption patterns. We're seeing it in people's decisions to leave jobs, to move. We're seeing it in the real estate market. So the pandemic is very much still with us, and I think some things will structurally change going forward as a result of the pandemic. We're just not sure exactly what it is. If you look at the labor force participation for different demographics, overall it's recovered in the US. It took a really long time, but there are differences, particularly among older workers. And I think that will be with us for a while. That said, we really struggled with supply constraints, not just in the labor market, but also, of course, with global supply chains during the pandemic and in the immediate aftermath of the pandemic. And if you look at a bunch of gauges for global supply chain tightness, it's actually eased quite a lot. So I think that piece has eased, and yet inflation remains stronger than what we'd hope.
Okay, inflation is stronger than we hope, but there's a belief there of getting back. Now, I don't want to get you in trouble with Bank of England here, but the former vice chair of the Fed, Richard Clarida, and others are debating a 2% idea. Would you suggest the greater theory of our macro policy forward is going to be an adjustment of any given central bank's band or target that they're getting back to?
So we're certainly beginning a debate about that, I think, among the intelligentsia, but I don't think we've made much progress on that. Some are calling for a higher inflation target in the US in particular, somewhere around 3%. The Fed and most other major central banks have defined price stability as a symmetric target around 2%. What the academic literature shows is that actually, until inflation gets above 4%, most people don't really notice it.
Yeah.
So I'm not sure. They don't notice inflation, at least, in terms of, the hit to their actual standards of living. So whether it's 2% or 3%,
right.
That may be more of an academic debate.
You absolutely nailed this. I got 1 minute left, Megan. I'm sorry, but this is research out of VCU that Olivia Blanchard is calling sentient inflation. Are we anywhere near sentient inflation where we're just comfortable with our inflation rate?
So no, I don't think we are near an inflation rate that we as the public or that the Fed's willing to tolerate in the US. Right. I think it will need to come down closer to the 2% target before the Fed's really ready to hang up its boots and be done with it. So as I said, we might get a pause in June, but I wouldn't take a pause to mean that the Fed is done. I think there's more work to be done.
Megan, very quickly here, and I'm really trying to stay away from the Bank of England police here, and I think I'm safe going here as well. One of the great things about Fenway Park, Megan Green, and it's not Narragansett Lager beer, it's the Yankee Lobster Company. Can you give us a rating on the lobster roll from the Yankee Lobster Company at Fenway Park?
I can't, Tom, because why would anyone ever get anything but a Fenway Frank at Fenway Park? So I've never had it. I stick with Fenway Franks.
Bottle that, and you will see that as she enters the August doors of the Bank of England. Megan Green, congratulations from the Kroll Institute. And she's 100% correct about hot dogs and beer at Fenway. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. Republican and White House negotiators are said to be moving closer to an agreement to raise the U.S. debt limit. Sources say the emerging agreement would cap federal spending for 2 years, permit defense spending to rise 3% next year, and offer concessions to both parties on energy. If a deal is reached soon, a vote in the House of Representatives could take place as early as Tuesday. And economists now think China's central bank will cut the reserve requirement ratio for major banks by 25 basis points before the end of the third quarter. That's earlier than they'd previously anticipated. This comes from Bloomberg's latest survey. They also paired expectations for GDP to 5.5%. And Bloomberg has learned that UBS and the Swiss government haven't agreed on the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of that takeover, including capital requirements and liquidity rules. And Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's been weighing on profits. Jacobs will become Lazard's executive chairman. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
In big idea is we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
You're always flying blind in this economy. There's a lot of choppiness, there's a lot of noise out there. I mean, I kind of, the big picture here, I think, in terms of the economy is it continues to expand. It seems at a, call it modest pace at this point.
Bloomberg Surveillance and Jay Bryson there from Wells Fargo really giving a wonderful perspective yesterday. This has been, in all the years I've been doing this, folks, to my team, I can just simply say this has been the strongest Friday before Memorial Day that we've seen. As John Farrell mentioned, it's been an extraordinary week. We saw this Monday, Tuesday, and it doesn't end today. The 2-year yield, 4.58%, is a wow statistic. The inverted yield curve goes from negative 50, 4 cups of coffee ago, to negative 76 basis points. The real yield maybe not getting the press it should, but the 10-year real yield, 1.55%. I want to take 30 seconds here on Peter Orszag. He was definitive at the London School of Economics. This is one of the rarest times where you see within Wall Street a true academic and policy wonk vault to being the chief executive officer of one of our storied names. This is, of course, Lazard Frere. Peter Orszag owns the high ground on research on our terrible medical system. I know it's not as bad as England and that, but as a young Turk, he was absolutely definitive in changing the debate on healthcare in America, and particularly on the processes of our complete garbage retirement system. I can't say enough about that. When you hear me say the phrase glide path, which is basically mathematics and Newtonian calculus, maybe it's from his father, iconic at Yale, but when you hear the phrase glide path, that's a direct steal from Peter Orszag. This is an inspired announcement by Lazard today. Okay, future's up 4, and we're going to get to the only interview that matters, and we're not going to talk about lobster rolls with Helene Becker. She is senior, what in God's name is going on with the airline industry analyst at Cowen, and joins us today. Helene, I'm going to talk with a safety issue. The Wall Street Journal had that BARS chart yesterday on collisions and near collisions of aircraft. Why are we seeing that?
Yeah, I just think there's a lot going on in the airline industry right now in aviation. Airports are really packed, as you know, and the runways are equally as crowded. Kind of think of cars on the highway at rush hour, sort of same for the planes. I want to say, though, Tom, that the U.S. aviation system is safe, probably one of the safest in the world. And these runway issues, I think, are just temporary as we get we work through some of the issues that are out there.
How far are we back to the summer of 2019?
We're there. We're past there. What I find amazing is we're forecasting beginning yesterday through Monday, Labor Day. So that kind of a little more than 3 months. 275 million people will travel via air this summer. And that is an increase over where we were 4 years ago, where we were last year, double-digit increase over last year, mid-single digits over 2019. So really strong summer.
What is the constraint moving forward to a better experience? Is it the planes? Is it the pilots? I saw an article that some pilots don't want to be promoted because it's not worth the money, etc. What's the Helene Becker constraint limiting us to a better experience?
Yeah, I mean, look, I think it's just the level of people and the lack of infrastructure. We've been talking about this for years at this point, probably since 2013, actually. In terms of pilots, the most senior pilots are retiring or have retired, and they're being replaced with younger pilots who just have to get up to speed. Not unsafe. I just want to reiterate the fact that pilots who work in the U.S. air system are as safe as can be and are well trained, and that's really important. But we do have a lack of air traffic controllers. Secretary of Transportation said a couple of weeks ago we were short 3,000. And when you think about how long it takes to become an air traffic controller, you realize we're going to be short thousands for years. This is not a problem that's going to be resolved this year or next year. It takes at least 2 years to 5 years to become proficient. And Tom, you mentioned pilots don't want to move from the right to the left seat. Well, controllers don't want to live in New York, Chicago, San Francisco, LA, Miami, where it's really busy and really expensive to live. They don't make enough money to afford to live in these cities.
Let's switch to the securities analysis of the moment as well. I've been thunderstruck how, to pick on United Airlines, Fortress Kirby, that, you know, they collapsed in the pandemic, they bounced off a little bit, and they've really gone nowhere. Are airlines a mother of all opportunities, Helene Becker, to rebound to pre-pandemic pricing?
Prices, yeah, I think they are. I think we're going to have a record summer, as we've talked about. I think, as you point out, the stocks are back to 2020 lows for the most part. And the pushback I get from investors is this is as good as it gets. Pricing is very strong, demand is very strong. And why will this continue, especially if we head into a recession? And the way I think about it is we're back to 2019 levels in terms of passengers, but capacity is down between 10 and 15%. And so you've got more seats per departure. They're up about 15%, 14%, but you have fewer departures per day. And so you've got 90+% load factors, which makes recovery from irregular operations difficult. But in terms of valuations, the airlines are going to make a lot of money, and nobody believes it. Nobody believes this is, or investors for sure don't believe this is sustainable.
One final question. Is our fleet aged? A guy named O'Leary was in here this week. He runs a small airline, and I think it's out of Ireland, called Ryanair. I'm trying to get Ryanair to come over here, Helene. I've failed so far. And he's talking about the purchase of 300 airlines from Seattle, Chicago, wherever Boeing's going to land here in the next 12 months. And the answer, Helene, is I'm worried about, like, the age of the fleet. It seems to be okay. Am I right?
Absolutely. So American has one of the youngest fleets. They refleeted between 2014 and 2020. This is a lower year for them for CapEx. United's in the middle of refleeting. They were the ones that didn't actually retire any wide-body aircraft during the pandemic, while the other two big airlines, American and Delta, did. Delta's been refleeting. So yes, we have a relatively, having gone maybe a decade ago from the oldest fleet in the world to right in there and right in the mix and on its way to the youngest.
Helene, one final question. The youngest afterthought emails in and says, can you ask Ms. Becker the wonderful cookies that Delta serves, when they come down the aisle with the tray with the cookies and the potato chips and all the stuff she tosses into her bag, Do they pay for that stuff, or is that like given to them free because people want the advertising?
No, they pay. That's included in their food budget.
Okay, I learn something every day. Ellen Becker, thank you so much. With Cowan as well. Really, really, really interesting time. And I'm sorry, folks, this is something we're going to do, and I really can't say enough about Bloomberg News aviation coverage. It is truly world class. And you know, you see like the article, the graph rather, in the Wall Street Journal, and you got to. This is something we're going to do, and I really can't say enough about Bloomberg News aviation coverage. It is truly world class. And you know, you see like the article, the graph rather, in the Wall Street Journal, and you got to lead with this stuff about, okay, we've come through this terrible pandemic, we're back, and what I'm hearing from Helene Becker there is maybe a lack of experience out there in the different parts of our transportation system. Stay with us through the day on radio and television. We'll give you really nationwide any of the slowdowns that we see. Should point out, for those of you thinking LHR, serious British Airways problems over the last, I believe, 2 days. Once again, BA has technological difficulties that have led to some real disasters at Terminal 5. Not disasters, that's not the right word, slowdowns at Terminal 5 at LH. Our futures up 5, Dow futures up 32. What I can say for Lisa and John, it's real simple. We have a changed yield landscape. 4.59%, up 5 basis points further from the ginormous move yesterday on 2-year yield is the headline statistic. We didn't talk anything today about the oddities of the 3-month T-bill market, given the debt coverage. Look, the balance of power today and our government coverage through the weekend on the debt crisis. It'll be interesting to see. I would assume there'll be no let up on that through the weekend, and that's expressed in our world in the 3-month Treasury bill, 5.31%. Less stated here is crude with a little bit of a bid here over the week, 72.63 on West Texas Intermediate. Will Kennedy saying that's still pretty darn cheap as things go. DXY 104. We're watching Euro, not a 106 print yet, but Euro worked weaker through the week. Coming up on lobster rolls, El Arian of Queens College. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisce with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend, a long weekend. Live from New York City this morning. Good morning, good morning. Equities higher, bond yields are too again. We're going to talk about that. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, the AI frenzy driving big equity market gains. A debt deal taking shape going into the weekend as investors price out rate cuts and price in hikes. We begin with the big issue, the race to secure a deal and enjoy the long weekend.
Republicans are driving us down a dangerous road of default. Many extreme MAGA Republicans have made the political calculation that a dangerous default and crashing the economy and triggering a recession is in their political interests.
The Democrats today are not the same Democrats. They're very extreme. We see them up their anger right now against the president when he's trying to curb spending at the same time negotiating with him. That's not productive.
So publicly, lawmakers are still busy insulting each other. Privately, the contours of a deal are coming together. According to people familiar with the matter, the two sides have narrowed some of their differences in recent days. Negotiators said to be moving closer to an agreement to raise the debt limit and cap federal spending for 2 years. President Biden remaining optimistic.
Speaker McCarthy and I have had several productive conversations, and our staffs continue to meet as we speak, as a matter of fact, and they're making progress. I've made clear time and again defaulting on our national debt is not an option.
Just for good measure, to focus minds, talk's getting another reality check. The Treasury's cash balance dropping below $50 billion, according to the latest data. That's down from more than 76 the day before and almost a third of what it was in the middle of May. Joining us now to discuss, Anne-Marie down in D.C. alongside Katie Lyons. Morning, Anne-Marie.
Good morning, John. So we are seeing potentially the contours of a deal before we head into this long Memorial Day weekend. And this is important because when Speaker McCarthy took the gavel, became Speaker, he told his members he would always give them 72 hours to read legislation. So potentially, if they're able to come to an agreement today, get the text worked up, we could see a vote as soon as Tuesday, and that's going to be necessary because we are really starting to close this gap ever so narrow towards June 1st. There's one thing we should mention when we're talking about the contours of this deal. Yes, it raised the debt limit. Yes, it caps spending. But at what level does it cap spending? What our reporting from Kayla Gardner and Justin Singh talk about is that actually defense spending would go up, and they do want to make sure that there is going to be enough funding for veteran programs. One win the GOP, Jonathan, may be able to get is that they're going to take $10 billion out of the $80 billion that's supposed to go to the IRS from the President's Inflation Reduction Act. But progressives, one win they're going to get is a measure when it comes to renewable energy. And this has to do with transmission lines, and the GOP will get speeding up of permits. So something in there for everyone. But Speaker McCarthy made it very clear. Not everyone is going to be happy with this deal. And that is why next week, even if there is an agreement today, is going to be very difficult.
And Katie Lyons, that's what we've got to focus on. What, or rather who, are you focused on right now?
Well, it's the far wings of both parties, right, John? Because in theory, those on the far right side of the Republican Party don't want Speaker McCarthy to be giving up too much. They would like to see deep spending cuts like in the bill that the House already passed. Then on the Democratic side, the progressives don't want to see stricter work requirements for entitlements. And we understand that that is an issue that has not been fully worked out yet. So if you have members of both parties that may not be satisfied with the ultimate compromise, that is what makes the whip count and the actual passage of whatever deal they come to very difficult. And again, we're working against the clock here because remember, June 1st, the earliest potential date Janet Yellen has outlined as the next date is on Thursday. There is not a lot of wiggle room, and even some of the ideas, the alternatives that have been floated to avoid default scenario like prioritization or the 14th Amendment or even something like a $1 trillion coin. Fitch Ratings in the last several days when issuing that ratings watch negative for the U.S.'s AAA credit rating said all of those things would not be consistent with the AAA rating and still could result in a downgrade even if the Treasury continues to make payments on its debt.
I'll speak for all of us. None of us want to be tracking this going into the weekend. AMH, Kelly Lyons, the two of you, wonderful work through this week. Looking forward to your coverage into next week as well. Joining us now, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, what a privilege to round out this week with you, and what an interesting week it's been. Can I just start in the Treasury market? Yields aren't falling. Treasuries aren't rallying. Yields are rising. Treasuries are selling off. Mohammed, what's going on there?
What's going on is that the marketplace is recognizing what you and I have spoken about, is that inflation is sticky and that the service sector in particular in the U.S. economy is red hot. So we are pricing in more Fed action, and we're also pricing in, ironically, John, that this will end up being a Fed policy mistake. So in addition to the yields moving up, we've got a two-step inversion now that's at 75 basis point. So you're getting the sense that the Fed is going to have no choice but to hike rates even more, but that will end up risking a recession because the Fed has started so late. And the marketplace has now embraced that possibility.
We were just reflecting on the debt ceiling saga at the moment. Mohammed, how different is this one to the one that you lived and breathed at PIMCO 10 years ago with 5% CPI?
It's different, John, because of the working assumption. At that time, we did not have the working assumption that this will get resolved. Most of us in the marketplace assume that this will get resolved. It doesn't mean there aren't longer-term costs. There are. There's three in particular. One is you erode trust even more in policymakers domestically. Two is you divert politicians away from the work they're supposed to be doing in order to enhance growth, enhance productivity. And third, you signal to the rest of the world that the U.S. economy is less predictable. So, even though we're going to resolve this, and I believe we are going to resolve this, there is longer-term damage being created.
I want to borrow a phrase of yours, risk mitigation characteristics. Do you think this erodes the risk mitigation qualities of treasuries?
It does, John, because it comes on top of many other things. Third countries, what Jared Cohen of Goldman Sachs called geopolitical swing states, they can go either way, are getting worried about reliance on the U.S. debt markets, about reliance on dollars. And unfortunately, the very well-intentioned and necessary sanctions on Russia, I want to stress they were necessary and they're well-intentioned, has pushed Russia into creating a small ecosystem, as cumbersome as it is, that bypasses the dollar. So now countries are thinking, well, maybe it's not as non-feasible as we thought initially. So the last thing we want to be doing in the U.S. is giving people excuses to look for little pipes that go around both the dollar as a reserve currency and our debt markets.
Well, you introduced the US dollar, so let's go there. Do you think the dollar crisis is over now that the dollar started rallying again, Mohammed? Now, I say that tongue-in-cheek, but we have had quite a move from 110.95 on the single currency all the way back down to 107.
Correct, because the interest rate differentials have moved in favor of the U.S. of the last month. John, you know this. We've moved 90 basis points higher on a 2-year in just over 3 weeks. 90 basis points.
It's amazing. I'm looking at the moves right now. We're almost at 460 on a 2-year. So this is the 11th day that yields have been climbing consecutively, 11 days straight. I go back to about 390 on May 11th, so that's something like 60, 70 basis point move just over that period. Mohammed, I was looking at the UK gilt market as well this week. The 2-year there up 54 basis points this week. Now, Mohammed, I think some people reflecting on the UK and the experience of September, October time, and a gilt crisis, if we can call it that, do you think there are maybe things starting to come together that remind you of what happened in that period?
Well, there's some fundamental differences, as you know, John. Back then, it was a fiscal policy mistake. Today, it's in response to not just headline inflation not falling as fast as people had expected, but core inflation going up. So there's now a recognition that the Bank of England is going to have to hike, and the market has priced in a peak rate of 5.5%. So it's not fiscal driving this, it is anticipated monetary policy. That's issue number one. Issue number two is that this is not viewed as a crisis. This is viewed as a chronic adjustment to higher inflation. And therefore, and this is important, therefore, the longer-term growth effects are going to be more detrimental. Mortgage rates are already moving up. Nationwide announced this morning 45 basis point increase in the mortgage rates. So this is going to make stagflation more likely than not in the UK, unfortunately.
There's the word, stagflation. Just for the UK or for others too, in Europe as well, given the disappointing data we've had out of China?
So, you know, when you go away from the UK, you don't have an 8.7% headline inflation. It's lower in Germany, it's lower in France. Now, we know that the German economy is already in recession. So, yeah, you may get stagflation light. The US is the one that should avoid it unless we get policy mistakes. So the US is the outlier in all this because its domestic economy is much more dynamic, much more resilient, and also much hotter, if you like, than elsewhere.
Mohammed, I just wonder how you'd characterize the inflation growth mix then in the United States, given the data we've had. We've talked about this a few times, both online and offline. You look at manufacturing data worldwide right now, it's screaming downturn, cut rates. You look at services, it's screaming hike. What is the kind of growth inflation mix you're expecting now?
So the inflation one is very straightforward, that because the Fed was late, inflation went from a few items to the goods sector and then got embedded in the service sector. And that has two results. One is it makes inflation less sensitive to interest rate increases. And two, it makes wage inflation more likely. So when you get that migration, and that's why economists hate a central bank falling behind, when you get that migration, you get a dualistic economy because interest rates will hit the goods sector, starting with housing, but will not impact the service sector as much. So that's what you get for a while, and then it depends on what central banks do. And that's why, John, the yield curve is inverting more, because the market strongly believes that the Fed is going to hike once, maybe twice more, and then it's going to have to reverse its hikes later in the year, because this will prove to be too much for the economy as a whole.
Final question then. Where are you for June and beyond on the Fed now?
So, John, what they should be doing, as you know, is they should be recognizing that the monetary framework is not fit for purpose. They should be recognizing that the inflation target of 2% is the wrong inflation target. And they should be implicitly aiming for a higher inflation target until the time comes when they have the credibility to change the inflation target. That's what they should be doing. And if that's the case, they would not hike. But I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike, even though your policy measures have a lag in terms of effects. And this is also a Fed that's so worried about its credibility that it's not going to be wanting to fall behind even more in the perception of people. And it doesn't have the confidence to stand up and say, look, we operate with a lag, and we don't want another policy mistake.
So just to be clear, as things stand, just to wrap it up, I know we've still got CPI still to come before that decision, payrolls as well, but as things stand right now, you think they hike in June?
I do, and the market thinks they hike in June.
Mohammed, we appreciate your time, sir. Thank you. Mohammed Al-Erian, enjoy the long weekend. Thank you, sir. Thank you very much. Looking for a hike in June. Bank of America just published, they say we still expect the Fed to keep policy rates unchanged at its June meeting, but it's a close call. And it's getting closer which is why you're hearing people like Mohammed say, we might be getting a move just around a corner. Let's get a move on now, going into the opening bell, 17 minutes away. Here's Abby.
Hey, John. Well, let's take a look at one stock that is soaring this morning, and that is the Gap. Shares are up more than 10%. It could be a short squeeze, though. There's a pretty decent short interest on this stock. Actually, it's coming off of those highs, but they put up a surprise profit of a penny versus a loss of 16 cents. And inventories are down, and gross margins are going in the right direction. On the other hand, Ulta Beauty, the opposite story. Their operating margin, they have cut it on theft. The CEO saying it's a concerning challenge. As for Marvell, well, the AI boom continues. They put up a big outlook for 2024 saying that their AI revenue will double.
Abby, thanks for that. Coming up on the program, traders pricing in another rate hike after a busy stretch of Fed speak.
Some of the declines we've seen so far in inflation have been a little slower than I might have anticipated, but we are starting to see some positive movements.
The economic data beating expectations. That conversation up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Some of the declines we've seen so far in inflation have been a little slower than I might have anticipated, but we are starting to see some positive movements, and I do think that, again, we can get there without a significant downturn, recognizing that there are a number of risks that we face.
And back and forth we go. Investors pricing out rate cuts, pricing in rate hikes, expecting the Fed to raise rates by another 25 basis points this summer. The change of heart coming with front-end yields moving higher for 11 consecutive sessions. And investors digesting a busy 2 weeks of Fed speak, revealing some of the divergence amongst officials. Citi's Andrew Hollenhorst expecting incoming data to keep, quote, the Fed on track to hike 25 basis points in both June and July to bring a terminal rate around to 550 to 575. Mike McKee, the data, pretty impressive stuff.
Data, pretty impressive stuff. Let's take a quick look at those Fed odds, because you're right, John. After the PCE inflation numbers, investors have totally changed their minds about what's going to happen on June 14th. 58% chance now of an increase on June 14th. And in July 26th, a 100% chance. So we're looking at somewhere between 25 and 50 basis points more going on. Here's the reason for it. Those inflation numbers, the Fed had been making progress, but that progress stalled in April as we saw the PCE numbers for both core and headline rising more than expected, and on a year-over-year basis, rising 4.4% and 4.7%. That is not obviously what the Fed wants to see. Interesting chart there you had with all of the Fed speakers that we've had, and we put the sorting hat on one more time, and we can see where they all are lining up at this point. And what is hard to tell is whether anybody's going to switch sides at this point. But right now you've got four voters who are on the team worried, four who are on the team pause. So where are they going to go? And the problem we're going to have, John, is we're not going to hear from Williams, Barr, or Cook now before this next Fed meeting, at least according to the schedule. So we don't know if we're going to pick up one on either side of those votes, but it's definitely going to be interesting going into June 14th to see what happens.
You call that a problem. Some people might be happy with that, Mike, because they get very sick of the Fed speak. And the good news is for those people that there is no Fed speak today going into the long weekend. Mike, always love catching up with you. Mike's going to stick around. We're going to catch up with Mike in about 30 minutes time or so, looking ahead to payrolls next week as well. Joining us now to discuss is Lafayette College, Krishna Mamani and Seema Shah of Principal Asset Management. Seema, I want to come to you. Andrew Hollenhorst says they're going to hike in June. Mohamed El-Erian, literally 10 minutes ago, said they're going to hike in June. What say you?
Well, so we have had a long-term forecast, or well, I guess a forecast for the last year or so that the Fed would peak at 525 to 550. So in line with that, yes, I think another hike is likely. Whether it's going to be June, July, I think is maybe up for question. You know, I know we've seen a lot of very strong data. We've just seen the core PCE numbers, but we still, you know, there is a lot to play for. There's still the CPI, there's still the non-farm payrolls next week, and I think things could switch. But certainly at this stage, and looking at the strength of the economy, looking at the strength of the stickiness of inflation that we continue to see, I think certainly the market is finally moving in the right direction and taking out rate cuts.
And the impressive data. Now, I said impressive twice there, and I'm using that loosely. Impressive relative to expectations, upside surprises. Krishna, has that impressed you?
Yeah, the economy itself has been quite impressive. You know, Mohammed talked about housing being the most interest rate sensitive sector. And if you look at housing data, there's no sign of any slowdown whatsoever. So I think the economy, you look at claims, you look at inventories, you look at consumption, you look at income growth, there's really not a significant sign of any slowdown whatsoever. You know, it may come down in the future, but it doesn't seem like that today.
I just wonder, Krishna, how divorced this market is right now from rates and this economy as well. When you look at the home builders, I had this conversation with Tom on Bloomberg Surveillance earlier this morning. From last June, the home builders on the S&P are up something like 60–70%, Krishna, even with rates at 7% for a mortgage in America. What do you make of that?
Well, so I think what that is telling you is that because of all sorts of reasons, economic restructuring in terms of people moving out in the suburbs, or stimulus, or come up with anything you want, that housing is probably is not as interest rate sensitive as we have assumed it to be based on our past experience. And I think that is the differential this time around.
Seema, what's your view on that one?
Well, so very, very similar view here from my side. The fixed rate situation in the US just means that there's very, very little interest in selling at the moment and getting a new mortgage at a considerably higher rate. And as a result, there's a lack of stock available for people who are looking to buy. And equity, there's always going to be people looking to buy. So then the one that's going to benefit from this is going to be home builders. So it is maybe a little bit surprising in the context of of significant rate hikes, potential for a slowing economy, but then taking a step back and then just thinking about the fact that you've got the fixed versus variable in the US, maybe it does make sense that the housing market is less interest rate sensitive than maybe previously.
Can you say the same thing about the economy? Or would you sit here and say it's all about longer variable lags from here, the cumulative tightening already delivered?
So we do believe that there is going to be a recession in the US. We think it's going to be a really short, shallow one. Clearly what we have seen from the US is, just generally speaking, not just of course the housing market, but it is less interest rate sensitive than you've seen in previous cycles. You know, you've got lower debt levels, You have the excess saving part of the equation, which continues to be really, really important. But these things are slowly being exhausted. So we do think that there will be a slowdown, but of course, it is certainly taking its while to play out.
Seema Shah, Christian Mamani, sticking with us. We're saving the equity market debate for about 7 minutes' time. We've got to talk about this rip-roaring story in big tech and AI specifically. So up next, the morning calls, then later, Wall Street starting to rethink the gloomy outlook. Citi joining a growing list of strategists that are warming up to equities. That conversation just around the corner. Equity futures higher on the S&P 500. The opening bell about 7 minutes away.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Five minutes out from the opening bell, equities up going into the weekend by about 0.2%. A little bit firmer on the Nasdaq, up by 0.3. That's the price action. Let's get to the morning calls. Morgan Stanley naming American Express a top pick, seeing an attractive entry point with potentially 20% upside. Piper initiating coverage on United Health with an overweight rating, expecting the company to deliver sustainable, best-in-class earnings growth over the next decade. That stock is up by 0.3%. And finally, Wolf Research downgrading Snowflake to peer perform, saying the current valuation leaves very little room for error. That stock just a bit softer in early trading. We're down there by 0.3%. Coming up, the rally in big tech, fueling fears of missing out. The bearish calls getting harder to hold. That conversation coming up next. Your opening bell just around the corner.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Five seconds away from the opening bell to wrap up a really interesting week in this equity market. Equity futures just slightly positive. Some positive follow-through after the monster gains in yesterday's session. On the S&P 500 right now, positive by 0.1%. On the NASDAQ, up by around about 0.3. There's the opening bell. Switch to the board and get to the bond market. Yields look like this, higher by a single basis point. 383 on a 10-year. On a 2-year, the data looking good again, relative to expectations. Mike McKee will give you a run-through of that a little bit later in the program. We'll catch up with him again in 15 minutes or so. But we have got on our hands right here 11 consecutive days of high yields at the front end of the curve. The 2-year up another 4, looking at 460. We're talking about 70 basis points worth of weight added onto the front end of the curve in 11 sessions. And with that, some dollar strength. A challenge to the Euro bulls. The Euro breaking down to about 107, trying to bounce. It's a pretty tame bounce. 107.32, positive by not even 0.1%. And crude struggling to get back to 73, 72.83, positive by about 1.4%. Around the open then, 40 seconds into the session, your broader equity market positive by 0.2% on the S&P, on the NASDAQ, up by 0.3. One stock to watch at the open is the Gap, reporting better than expected results, with cost-cutting measures improving the retailer's profitability. The interim CEO saying, quote, "We continue to take the necessary actions to drive critical change, ultimately getting us back on a path towards delivering consistent long-term results." Abby has more. Hey, Abby.
Hey, John. Well, they did put up a surprise profit. They put up a penny versus the estimated loss of 16 cents. And as you mentioned, it had everything to do with cost cutting along with discounts. Now, relative to the cost cutting, they had a reduced headcount. They also trimmed other expenses. On the discounts, it had to do with freight and other types of discounting their merchandise less. But it's a top line issue. So this stock going into today down more than 30% and 11% short interest. So today's pop up about 10% right now could be a short squeeze. The question is whether or not they can return the Banana Republic and the Athleta to greater growth. Comps at both of those stores declined. Old Navy down just a little bit. The Gap up 1%. So they need to get the merchandise right so that they can also get the top line growth that they need for that long-term turnaround that they're talking about. But perhaps this profit, some of the bottom line coming into view in the way that analysts would like to see, a good start, John.
Nice pop for that name, up almost 12% right now. Abby, thank you. Jeffrey's weighing in on this story and writing the following. We view these results and the company's reiterated guidance as encouraging. However, we're exercising some level of caution given the uncertain macro environment and ongoing business restructuring. They reiterate their hold rating. That name, though, still up by more than 10% in the first 2 minutes of trading. Sticking with retail earnings, Costco delivering mixed results, topping earnings estimates, but reporting weaker than estimated revenue and comparable sales. Simone Foxman has more. Hey, Simone.
Yeah, John, it took markets a little bit in terms of digesting this. There was a sell-off initially, but then once traders realized there was a pretty large one-time 50-cent per share charge, shares recovered for the most part and now are a little bit higher on the day. But there were signs of weakness in this business, especially in the United States, where Costco gets 74% of its revenue. U.S. comparable sales, excluding fuel and currencies, up 1.8%. The estimate had been for 3.5%. Really, Costco, though, echoing the message we've heard from a lot of big box retailers: smaller ticket size, stronger buying on discretionary stuff, but not so much buying on the bigger margin sorts of things like electronics, home furnishings. A deceleration in sales growth, though, may have been priced in. The company had its weakest sales growth in March in 3 years, and it didn't accelerate that much in April. Maybe that's why we're seeing some positive numbers today. Still, analysts, though, very positive on the stock. There were 27 buy ratings, 14 hold ratings, but 0 sell ratings going into this earnings.
Amazing. In line with the broader market, just about positive, up by 0.3%. Simone, thank you. The broader market up by 0.3%. The Nasdaq up by 0.4%. Let's sit on the Nasdaq and turn to tech. Workday lifting its subscription revenue forecast for the rest of the year, easing anxiety over the appetite for corporate software spending. Katie has more. Hey, Katie.
Hey, John. Yeah, Workday off to the races this morning. Just some context. This is a company that makes software for HR management, among other things. And like you said, it lifted its guidance for that annual subscription revenue. That is a key metric for this company. Those new numbers are $6.55 billion to $6.58 billion. So bumping up the previous lower end of that range. And like you said, going a long way towards reassuring investors that there's still appetite out there among corporations. Remember, we got some results from Snowflake earlier this week that had fanned concerns, but these Workday numbers went a long way towards, again, reassuring investors, not just in the guidance, but also in the previous quarter's results. Fiscal first quarter sales rose 17%, topping estimates. Subscription revenue jumped 20%, and to boot, the company named a new CFO as well. You've seen sell-side analysts just clamoring to raise their price targets. I've seen 3 of them already, and you can see that Workday shares of about 9% at the moment.
Third best performing name on the Nasdaq 100 currently. Katie, thanks for that. Let's get to the number one. It's this one. Marvell recording its biggest intraday jump since 2001, saying it expects revenue from, guess what, AI technology to soar throughout the year. Alex Webb has more. Morning, Alex.
Good morning, John. It's really the tale of what we've been seeing with NVIDIA yesterday, the stellar numbers coming out of there. Marvell is in a slightly different space from NVIDIA, but it does make some chips that have AI applications, and that really seems to be what investors are picking up on. The key thing they're saying is that AI revenue will double in fiscal 2024. When you look at the numbers a little bit more closely, it was $200 million in the previous year, so maybe looking at a doubling to $400 million. That's clearly not nothing, but in the scope of more than $5 billion in annual revenue, it is by no means the lion's share. Nonetheless, we've been seeing growth across some of the other areas. Consumer revenue up, carrier infrastructure revenue up, enterprise networking revenue up, automotive also up. All those things clearly underlying businesses that continue to do pretty well. We do not expect this to be the last time we hear a company bigging up their AI prospects, even if some might say they're not as big as you would think.
I wonder how much, Alex, that is part of the move today, just talking about it. Alex, the move yesterday in NVIDIA. Can we finish on that? Alex, what did you make of that move? Just historic.
It's huge numbers. You know, the amount they gained yesterday was more than the entirety of Intel, which was for the longest time the world's biggest chip maker. We're seeing a huge sea change. Talking to analysts today, NVIDIA has placed itself so incredibly cannily, you know, encouraging people to use their entire chipsets if they want to get a piece of the AI business, if they want to get a piece of their AI technology as well. I think the key thing we take away here is what we've learned about what AI is going to be as a business. It is a cloud business right now. It is a way for Google, Microsoft to get people using their clouds. That's why they're investing so heavily in NVIDIA, and that dictates the way that AI is being distributed to the world.
Interesting. Alex, just wonderful coverage, mate, as always. Out of London, Alex Webb there on NVIDIA and other names as well. That helped drive the Nasdaq 100 to its biggest one-day gain for the month of May just yesterday. Some positive follow-through. The Nasdaq up by 0.5%, the S&P up by 0.3%. As tech stocks mount up, Are bearish views beginning to mount down? Morgan Stanley's Andrew Sliman now saying stocks could hit 4,600 by year end as FOMO starts kicking in. Quote, if it gets to October and I haven't made money for my clients, then I would start to get nervous. My conjecture is cash starts to get back into the market later into the year. Bank of America's Savita Subramanian boosting her year-end target to 4,300, saying the skeptics are making something out of nothing.
Narrow breath is not a precursor for doom and gloom. I think it's kind of a false negative. And then when you look at valuations right now, they look high, which is another reason nobody wants to buy stocks. But valuations generally look high when you're in an earnings recession, which we are. If we are in this sticky inflationary environment, do you really want to be in cash or bonds? Don't you want to be in stocks that participate in inflation?
Morgan Stanley's Mike Wilson pushing back.
The bear market is continuing, okay? This is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, probably sell them at the wrong time. We think that the fundamental case does not support, where stocks are trading today, whether it's at the index level or at the single stock level. And the second half is going to be a bit choppier and probably downward in the index.
Back with us on this story, Krish Mamani, Seema Shah. Seema, I wanted to come to you on this and ask you specifically, does narrow breadth matter to you?
Oh my goodness, yes, it really matters. Look, we have, as I said before, we have a view for a recession, and that implicitly should mean that the S&P 500 will go down. And yet, then you have the narrow breadth. So at this point in time, it is so important for investors to not just be looking at the index level, but looking deep under. For us, large cap, mega cap tech stocks, or specifically mega cap growth, I should say, we're always going to do well in this cyclical environment, right? You have a slowdown approaching, you have the Fed at least approaching the end of the cycle, and then of course you have the rest of the global economy looking better. So that implicitly should do well for mega cap tech, and then you add in the AI story, and that's a secular driver. So there's a number of reasons why mega cap tech should be doing well, but it doesn't mean that the rest of the market is going to do well. And certainly if you look under the cover, then actually the other sectors are really struggling. So actually the recession call, the broader market story of weakness does continue to drive through, but that narrow breadth is the number that you're going to see if you look at the screen. You just look at the S&P 500 and you're going to think, wow, things are fantastic.
Well, you can look at the S&P 500, or as some people have joked, many people have joked over the last week, you can look at the S&P 495. Now, Krishna, when you look at those two things right now, I think you could have said the same thing for much of the last 10 years at times. 5 big names driving the stock market higher. What's different this time?
Well, so I think Savita is right. That is, it always seems like breadth is narrow when you are at this point of transition. I think what the question we have to ask ourselves is tech going to go down, or rest of the market is going to catch up to tech? At least some parts of the rest of the market catching up to tech. And I think that really ends up being a call on whether we are going to have a recession or not. And I think on that front, it's quite clear, at least for the, Mike Wilson was talking about the second half. I think second half, from a growth perspective, there's really no challenge whatsoever. If there is any challenge, it'll be that the rate cuts would be priced out. I don't think that is so bad for the 495.
Krishna, your time horizon's different, and time horizon matters. You've got a tactical call, upside risk, and I've been asking this week, is the bigger risk a mount up or a mount down? Do you still think it's that upside risk that's still underappreciated?
Yes, I think the upside risk to the market is much larger than the downside risk. The downside risk was contingent on some signs of a recession, and we don't really see that. Stocks are nominal instruments. When you have this level of nominal growth, expecting that things are going to just crater, I don't think is a realistic thought.
The rally in these names has been so polarizing. As you both know, Meta up more than 100%, Nvidia's more than doubled so far year to date, and it is May 26th. We've got some runway here to get to the end of the year. Seema, I just wonder, do these AI members, these AI winners, speak to another era of US exceptionalism in the equity market? That was where the outperformance was for the last decade. And those names did not exist in Europe. And I feel like this is the early innings of having this conversation again. Is that what this is?
I think you're absolutely right. I think for a little bit of time at the beginning of the year when Europe was doing well, there were maybe some considerations that actually this could be shifting into a more European decade. And we've just seen from technology that, look, Europe just doesn't have the same kind of names. It doesn't have the same kind of strength. So from that perspective, AI, as long as it's not going to go away, as long as regulation doesn't come in and completely clamp it down, then this is suggesting that the US market is a place to be if you're looking out there for a 10-year horizon, absolutely.
Krishna, what do you think the message that is being sent right now from the likes of NVIDIA, Meta, Microsoft, to people who are long the Euro Stoxx 50?
Well, the message is pretty simple. I think the European economy is slowing down for sure, and Germany is probably the best example of that. And if bad things happen in China, it gets impacted a lot more. I think the developed market away from the US at the end of the day still very much remains a trade, and it comes and goes. I think from a longer term perspective, the likelihood that other markets away from US are going to do materially better, simply driven by valuation, I don't think is a really good thesis.
We've heard that argument a few times, haven't we, Krishna, over the years?
Yes, we have.
Krishna Mai, Seema Shah, to the two of you, wonderful as always. What an interesting moment for this market. It's such a polarizing story right now. If you're in it, you've been loving it. If you're out of it, you're wondering if you should get in or carry on throwing mud at it. Your equity market right now, 13 minutes into the session, positive by 0.6% on both the S&P and on the Nasdaq too. Coming up, more resilient data ahead of the Fed's June meeting.
I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike.
That conversation coming up.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
World of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike, even though your measures, your policy measures have a lag in terms of effects. And this is also a Fed that's so worried about its credibility that it's not going to be wanting to fall behind even more in the perception of people. And it doesn't have the confidence to stand up and say, look, we operate with a lag and we don't want another policy mistake.
Mohamed Al-Arian on the program in the last hour saying they will hike in June. That's his expectation as things stand. As things stand, there's some runway before we get to June 14th. We have payrolls on June 2nd. CPI on June 13th, and you hope that we get a debt ceiling ex-date somewhere in between and a deal before we hit it. That's going to be the story over the next couple of weeks. Mike McKee back with us for more. Morning, Mike.
Good morning, John. Well, the numbers that came in, to quote the late, great Alec Guinness, are not the droids the Fed is looking for. We saw personal income and personal spending both rise in April over March, and inflation rose on a headline and core basis. This is not what the Fed had anticipated, even though they thought we might have some volatility. And here's a really interesting number for you. We saw goods spending rise more than services spending, and we had thought there had been a rotation out of goods. It looks like that is turning around. So that could be a problem down the road if we still start to see goods inflation rise some more. By the way, that PCE core services ex-housing number that is sort of Jay Powell's talisman, that rose on a month-over-month and headline basis during the month of April. So what we're looking for now is the next in the series of numbers you mentioned, John, jobs. Next week, 188,000. Now, that is up from earlier this week. They do see, the economists we survey, a slight rise in unemployment, but not a big change in average hourly earnings. So it looks like status quo. And if Mohammed says that means the data are saying raise rates, the Fed's probably going to want to raise rates.
Mike, amazing, isn't it? That unemployment rate, even with that tick high, is still a full point where the Fed expects it will be by year end.
Yeah, and there's no way we're going to get the kind of jobs numbers they're looking at by year end now. So this June meeting is one in which they give us new economic forecasts. It will be interesting to see what they come up with.
Hyper-focused on those projections, the summary of economic projections, the SCP in that release. Mike, thank you, sir. Just wonderful work. Tremendous as always from Mike McKee on the Federal Reserve and on the economy. Here are the job cuts. JP Morgan notifying 1,000 First Republic employees they aren't being given jobs. Bloomberg breaking the news and reporting that 85% of the failed bank's employees were offered full-time or transitional roles. JP Morgan said this: since our acquisition of First Republic on May 1st, we've been transparent with their employees and kept our promise to update them on their employment status within 30 days. We recognize that they have been under stress and uncertainty since March and hope that today will bring clarity and closure. Shanali, the White Knight, sharpens that sword.
The sword is certainly sharpened over there at JP Morgan. Remember, JP Morgan, John, has expanded its headcount over the last couple of years. They've really bucked the trend already when you've seen about the job cuts that have reduced headcount in certain places on Wall Street. JP Morgan just got bigger. Now with First Republic, remember, there will be roles that are duplicated as they bring in First Republic. And even among the jobs that are offered to First Republic employees here, this is about 85% of the 7,000 employees at First Republic. There are many that are offered as transitional roles as well. That is transitional roles between the space of 3 months to a full year. So even in the next year or so, there are going to be questions about how many of these First Republic employees really stay on. This chart is pretty extraordinary, and a really fun fact here. This is the compensation per head count. And at First Republic, you see that it is much more than over at JP Morgan. Remember, JP Morgan is a very large bank with a lot of consumer businesses here as well, so that pay is very dispersed among a wide array of bankers. First Republic was known to bank wealthy individuals and therefore have a lot of kind of private wealth type bankers, but the pay is large relative to the pay per head count you see at JP Morgan. That is what you would expect at a firm like that. JP Morgan is already a story about keeping expenses under control. More on this story ahead, John.
Well, speaking of another story, let's squeeze this in. Some reading for the beach this weekend. Fantastic story written by Shanali and the team. Shanali, the headline: infamous hedge fund trade draws fresh scrutiny during the debt saga. Just give us a tease of what people can expect in that piece.
Yeah, you have to keep an eye on it, John, because if you're JP Morgan, Citigroup, Goldman Sachs, or any prime broker on Wall Street, you're probably getting questions here from regulators because they're worried. The Fed has had to step in before on highly levered trades that hedge funds have made in the Treasury market. The Treasury market has been very volatile. People are worried about overnight financing. People will continue to be worried about overnight financing. Ripple effects are really still unknown, but hedge funds are certainly levered to this market. Crowded trades in there, John.
Very cool. You can find that story on the Bloomberg Terminal and on Bloomberg.com. Shanali, thank you, as always. Let's get you some sector price action. The equity market in this session highs the Nasdaq up by another 0.8%. Here's Abby.
So not surprisingly, John, today with today's gain, a two-day gain for the S&P 500, most sectors are higher, led by tech, up more than 1%. We also have discretionary materials, industrials higher. The only sector lower, utilities. This as yields continue to surge higher. Those dividends look less attractive. Very interesting, though, on the week, the S&P 500 is down about 0.7%, and almost all sectors are lower except for technology. That's true, too, on the year. I was shocked by this. It would actually support the idea that we're going sideways or even down. Internal breadth that you're talking about, not great here. Tech up 32%. Take a look at these other sectors. They are lower, John.
That's some real divergence. Abby, thank you for that. Coming up, your trading diary.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Once again, same old story. The Nasdaq leads. Nasdaq 100 up by 1%. About 26 minutes into the session, the S&P doing okay as well, up by 0.6. That's the price action. Here's the trading diary. Coming up, UMich Sentiment Survey, top of the hour to next week. Markets closed, of course, for Memorial Day on Monday. U.S. consumer confidence numbers out on Tuesday, Thursday. Secretary Yellen's ex-date, plus ISM's manufacturing. And Friday is the U.S. payrolls report. From New York City, that does it for me. Thank you for choosing Bloomberg TV, and please do enjoy the long weekend. I'll catch up with you on Tuesday. This was the Countdown to the Open. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from 10 million